All right, morning guys. Hope I'm audible. All right, thank you. So let's all right. So let us finish off two more other standards today. And then get into consolidation. Yeah. So from CA final, if you see the standards which are pending are AS 25 and 28. 25 and 28 are pending. Apart from that, first generation standards which you have in IPCC are pending. That I'll do a little later. For now, today we will first finish off these two standards and then go ahead with consolidation. So this is the agenda for today. Now let's start with AS 25. Interim financial reporting. If you observe, interim financial reporting happens predominantly in listed entities. Interim financial reporting means a financial report or a set of financials which are prepared for a interim period. Interim period. What does interim mean? Interim means a part of the financial year. Part of the financial year is what we call as interim period. Now, when I say interim period, can I reckon it as, say, a company got established in September of 2019. So should I call September to March 20 as interim is a question. Standard says if it is newly incorporated entity, doesn't mean that part of the year is called as interim. No, that is a full financial year for that particular entity. When we prepare financials out of a full period for a part of a period, then we call it as interim financial reporting. Now, predominantly, standard does not tell to whom all this particular standard is applicable. However, out of the standard, SEBI gives you guidelines on which companies have to adopt interim financial reporting, or MCA through its notifications would give you guidelines of who should prepare interim financial reporting. Now, having said this, what are the basis for interim financial reporting? Interim financial reporting is prepared based on two principles. One is timeliness. Second is materiality. What is timeliness? What is materiality? If you look at most of the listed companies, out of the 4 quarters, every quarter they keep publishing information to SEBI. So every quarter results when announced, what is important for me is it should be announced within X number of days from the closure of that particular quarter. So that means more than correctness, what is important is timeliness. More than accuracy, if the information is materially true, that is sufficient. They do not look at accuracy. However, there is requirement of they ensure at least 90 to 95% of accuracy in the information provided. So predominantly what is looked for is timeliness and materiality rather than correctness and accuracy while we prepare interim financial reporting. Now, having said this, let us get into how an interim financial report is prepared, what all should be the contents inside it, and principles in preparing a interim financial report. Now, an interim financial report can be prepared in two ways. One is called as a condensed form. Second is a full form. What does condensed form mean? We will give a abridged version of the balance sheet, P&L, notes to accounts, and all the stuff for that particular quarter. Then we call it as condensed form. Otherwise, we call it full. You may adopt either of these two. When adopted, you are supposed to prepare, number one, a balance sheet. Number two, a profit and loss account. Number three, select explanatory statements. With respect to wherever it is important and critical. Then cash flow statement. So predominantly, these are the information which we provide to submit to SEBI whenever there is an internal, interim financial report being prepared. Now, how are these prepared? For quarter one, if an interim financial report is being prepared, this should be the contents in that particular report. So that means for a cash flow statement, P&L, or a balance sheet when prepared, these columns should be maintained. If it is for the first quarter, particulars, Q1 results of current year, comparable information from last year, that is previous year, and then you have last year's audited, audit report, whatever auditor's side, whatever is provided is also given. So predominantly for first quarter, it is simple. But when it comes to Q2, along with Q2 results of current year, it requires Q2 results of previous year, and additionally there is something called year to date, that is Q1 plus Q2 of this financial year. This is what we call as year to date of current year and year to date of previous year. So Q1 plus Q2 of previous year is also required. Okay. So whenever we prepare for second quarter, these are the columns which are supposed to be maintained. When it comes to third quarter, Q3 results of current year, comparable Q3 of last year, that is previous year, again year to date. Year to date indicates Q1, Q2, Q3 of current year, and year to date of previous year. So these are the columns which are required if it is for third quarter when we are preparing. And lastly, for Q4, if you observe, for Q4 results of current year, comparable Q4 results of previous year, unaudited financials of current year, because this is nothing but YTD, year to date, and same way audited financials of previous year, So this is how we prepare an interim financial report for each of this quarter. Now, standard specifies interim means it could be any part of the financial year. However, it did not specifically mention that it should be for quarter. But SEBI requirements wise, we generally prepare and submit for every quarter. That is how SEBI has asked, hence it is being prepared. Can I prepare an interim financial report from April to September? Yes, if your management wants to. So it all depends on how the stakeholders of the company are looking at it. If they would like to have only for 3 months, then it is 3 months information. If they would like to have 6 months, it's 6 months information. 9 months, even then it is interim financial report only. Only requirement is it should be part of the full financial year. Only then you call it as interim financial reporting. Now, having understood who should prepare, how it should be, for in what columns it should be prepared for each quarter, let us now look into how it is supposed to be done. Now, recognition and measurement. How you prepare your annual accounts, the same methodology has to be adopted for interim financial periods also. That means whatever is allowed to adopt in an annual financial reporting presentation, the same is allowed to be adopted even in interim financial reporting. The only exception being taxation. So all your expenses, incomes, assets, liabilities, everything is accounted just like how you prepare your final financial statements. The only exception being taxation. When we come to taxation, I'll discuss about it. For now, understand that this is the principle on how we are supposed to prepare interim financial reports. Now, having said this, what sort of information is important for us in understanding a interim financial report? There are few specific cases. One, an extraordinary item. Second, accounting policies. Third, accounting estimates. These are three things. Estimates. These are three things which are important for us to understand. Now, how should extraordinary items be accounted for? Any extraordinary item is supposed to be shown separately under AS 25. So you disclose profits or losses before extraordinary, after extraordinary and all. So that is one important thing. And the quarter in which that extraordinary item has happened, only in that quarter such extraordinary item should be disclosed, and there is no requirement of rephrasing the previous quarter based on an extraordinary item in the current period. So that is one important aspect when it comes to extraordinary items. Second, when there are changes in accounting policies, there is requirement for us to give a retrospective effect. Retrospective effect. I believe you all know what is retrospective effect. That means while I prepare, say I am preparing for Q3 of a financial year. In such case, while I prepare my comparable information, they should be prepared with the your year to date data should be prepared with the retrospective changes. Say Q3 data is being prepared. Q3 data, current year, whatever I have prepared with the new accounting policy should be given. Q3 data of previous year as per that particular policy should be given. However, while preparing year to date data of current year, this should be prepared using new accounting policy, whatever we have adopted, because in the current year there is a change in accounting policy and it should be brought effective in the entire financial year. And lastly, year to date of previous year. Year to date of previous year is also prepared. So predominantly this is what important for you from accounting policies point of view. When it comes to estimates, whenever there is a change in estimate, such changes should be taken up only prospectively, but not retrospectively. Hence, any estimates changed in the current quarter will be applicable only for current quarter. The previous quarters you need not touch at all. There is no requirement of making changes in the previous quarter due to this changes in estimate in current quarter. So this is broadly the info which is required for you from accounting perspective. Now let us quickly see through the problems given in this and go ahead. So take out the first question. Extraordinary items again. Yeah, I don't mind. We'll do. Whenever there are extraordinary items, such extraordinary items impact should be given only in that quarter. For example, there is a fire in Q3. In such case, loss due to extraordinary item should be disclosed only in Q3. You should not give impact for the whole year. You cannot spread it over the whole year. Okay, so that is what specifically it mentions here. Can someone tell me page number, please? Thank you. Yeah. Please see first question. Zamindars India Limited has 1,02,000 net income for the quarter ended 31st December 2014, including the following items. 60,000 extraordinary gain received on July 30, 2014 was allocated equally to second, third and fourth quarters of financial year 2014-15. 16,000 cumulative effect loss resulting from change in method of inventory valuation was recognized on November 2nd, 2014. Out of this loss, 10,000 relates to previous quarters. Required compute profit as per AS 25 for the quarter ended 31st December 2014 of Zamindar India Limited. Now, there are two adjustments he is asking you to do. The first one happens to be an extraordinary item. Second one happens to be what? Second one happens to be change in method of valuation of inventory. Now, if you observe, change in method of valuation of inventory is change in accounting estimate, but not an accounting policy hereafter. Okay. So considering that, you are supposed to take impact only prospectively. Okay. So these are the two adjustments which you are supposed to make here. So let us do the problem. He has given you income as, so Q3 is the quarter. Income what he has given you is 1,02,000. Sorry. 1,02,000 is the income. Extraordinary items are there. Extraordinary items are there. He says it is split over multiple quarters. 60,000 extraordinary gain received on July 30, 2014 was allocated equally to second, third and fourth quarters of financial year. What is supposed to be done? The entire 60,000 should be shown only in second quarter. It should not come to third quarter at all. Okay. That means in this profit which he has given 1,02,000, this 20,000 is already included. So what should be correct profit? I should reduce that 20,000 from my financials. So extraordinary gain wrongly taken, 20,000 deduct. Third, with respect to your 16,000 cumulative effect loss resulting from change in method of inventory valuation was recognized on 2nd November. Out of this loss, 10,000 relates to previous quarters. Okay. So out of this 10,000 relates to previous quarter, it is supposed to be taken in that only. Now you are not supposed to take. It's only prospective but not retrospective. Okay. So what we should do is 10,000 should be added back, because 16,000 is deducted. 16,000 is deducted, only then I have got this 1,02,000, of which he says 10,000 does not belong to this quarter. Hence what I should do is I should take it, reverse it back. So I will have to add this amount now. Inventory valuation loss of previous quarter, 10,000 rupees add. So effectively your loss now has become 92,000. Second item, I'll repeat once again. 16,000 is the effective loss from change in method of inventory valuation. If you recollect, a couple of years back, there is a amendment in standards where your changes in inventory valuation and then changes in depreciation are not policy changes, they are estimates. They are estimates. Hence, this is an estimate, change in estimate. Any change in estimate should be given only prospective effect but not retrospective effect. Okay. Now, out of this estimated loss of 16,000 which you are taking now, which you have taken already, 10,000 belongs to previous quarter. 10,000 belongs to previous quarters. I should have accounted then. I should have reduced my profits then and shown. But wrongly, I have taken this entire 16,000 in the current year, current period itself, current quarter itself. Hence, what we are now doing is we are going to reverse this 10,000 so that my profit gets adds another 10,000 rupees here. I hope this is sufficient. All right, thank you. So this is the first answer. 92,000 is the amount here. Okay, next. Please take second question. ABC Corporation is dealing in seasonal products. Sales pattern of the product quarter wise is as under. First quarter ending 30th June 15%, second quarter 15%, third quarter 50%, fourth quarter 20%. Total comes to 100%. For the first quarter ending 30th June 2014, ABC Limited gives you the following information. Sales 50 crores, salary and other expenses 30 crores, advertisement expenses 2 crores, administrative and selling expenses 8 crores. ABC Limited, while preparing interim financial report for first quarter, wants to defer 16 crore expenditure to third quarter on the argument that third quarter is having more sales. Therefore, third quarter should be debited by more expenditure. Considering the seasonal nature of business, the expenditures are uniform throughout all quarters. Calculate the result of first quarter as per AS 25 and comment on the company's view. Now, what he is trying to say is he would like to transfer some expenses from one quarter to another. Is that valid or not is the question for us here. Now, I'll repeat the initial discussion what we had today. Whatever is not tenable while preparing the full financial statements, the same cannot be applied in a interim financial report also. For example, you have incurred an expense of 20 lakhs in the current year. You have utilized the entire benefit in the current period itself. Will you take it as an expense in future period? You will not. Same logic is to be applied for quarters also here. So here, what is important is every quarter should be considered as a separate period and accounted for. Okay. So his intention of deferring 16 crores to next quarter is not at all acceptable, even though it is a seasonal business. Generally, this intentions will be there in sugar manufacturing units, then tobacco manufacturing companies and all, where their operations are only for 6 months. They try to showcase more expenses during when there is sale, and when the off season starts, they try to show less expenditure to showcase that they are still running in profits. Fact is, there will be expense throughout the period. But during the seasonal time, their profits will be there. In off season, there might not be profits. So this is how you are supposed to recognize in your books of accounts. So let us do this problem. So he has given you a revenue of 50 crores. And then he has given you expenses stating salaries are given for 30 crores. Advertisement is 2 crores. Admin cost 8 crores. Okay, I'll do that. Let me finish this first. Okay. So profit would be 10 crores. Now, I'll repeat this part once again. What he is saying in this question is, he wants to defer 16 crores of expense to third quarter. Should I allow is the question. It is not allowed. Reason is very simple. Whatever you are incurring in this quarter is this quarter's expense. Your presentation should be fair. You cannot tell that in this quarter I have incurred less expenditure, in future it is more expenditure and all. That's not acceptable at all. Okay, what is supposed to be done is, in whatever quarter you have incurred an expense, in that quarter itself it should be booked. It cannot be transferred to future periods stating that there you have more profits, so you can adjust that profit by incurring this loss, this expense and all. Okay, so what is important is, whatever expense is incurred in a period, in the same period you are supposed to expense it off. Okay. So this is for this question you can write a note also. Please write a note for this. The company's intentions are not acceptable. The company's intentions are not acceptable because what cannot be done on an annual basis, cannot be done on a quarterly basis as well. Cannot be done on a quarterly basis as well. Yeah, I'll come to that, Thirumalai. Please complete this. Therefore, company cannot defer Q1 expenses. Defer Q1 expenses to Q3 expenses. Now, advertisement expenses, Mr. Thirumalai, what you have asked, yes, you can do if he specifically mentions in the question that the expenditure has got benefits over periods, over quarters. Otherwise, you cannot. So, next question. Please take third question. On 1st April 2014, B Associates entered into a 5 lakh fixed price contract to construct a factory building for manufacturing company. Building account for this contract under the percentage of completion method and estimated cost at completion at the end of each quarter for financial year 2014-15 is provided below. Cumulative costs incurred to date amounts are given. Estimated cost yet to be incurred at quarter end. Progressive billing made during the quarter. Collections of billing. What amount builder as income should report on construction contract in its quarterly income statement based on the above information. So here specifically he is asking you to show how interim financial report is to be prepared by construction companies. That's all. Okay. So let us do that. In construction companies, you adopt something called as AS7. So considering the same, let us do now. Now for the first quarter, please see what is the percentage of completion. If you recollect under AS7, percentage of completion method is adopted. So considering that, we are supposed to prepare interim financial report. So for Q1, he says that percentage of completion is 1.5 lakhs is completed out of 4.5 lakhs. Okay, 1.5 lakhs is completed out of 4.5 lakh, which means percentage of completion is 1/3. Which is percentage of completion is 1/3. So revenue, how much can I recognize? Revenue, how much can I recognize? Revenue can be recognized out of the total revenue of 5 lakhs. I can recognize 1/3. Okay. So 1/3 of 5 lakhs come to 1,66,667. And cost incurred till date, please see. Cost incurred, cumulative cost incurred till date is 1,50,000. Yes or no? Cumulative cost incurred is 1,50,000. So I am supposed to take 1,50,000 only as cost. 1,50,000 as cost. So profit for first quarter to be disclosed is 16,667. I hope you guys are able to follow. What we did in this problem is, he's asking you to provide quarter-wise revenue, cost and profits. And this company happens to be a construction company. Hence, we have taken construction contracts AS7 as base to do this. AS7 as base to do this. Next. For Q2, in the same way, percentage of completion is to be calculated. Percentage of completion, if you see, till second quarter, cumulative cost incurred is 3,60,000. So 3.6 lakhs divided by, denominator is 4,05,000. Let me see. See, for the first quarter, when you are doing, you are supposed to take this and this. Okay. So while you are doing at the first quarter, by the time of first quarter, you have incurred 1,50,000. And at that juncture, you feel that if I spend another 3 lakhs, it will be done. Hence, for the first quarter, your total cost incurable on the project is 4,50,000. For second quarter, what will it be? It's going to be 3,60,000 divided by 4 lakhs, because it is 3.6 lakhs plus 40,000. I hope I may be, you're able to follow. Yeah. So 3.6 lakh divided by 4 lakhs, which comes to 90%. So revenue to be recognized in second quarter is 5 lakhs into 90%. You get some number. It's going to be 4,50,000. However, out of this 4,50,000, already recognized in first quarter is there. Already recognized in Q1 is supposed to be deducted, which is 1,66,667. Is to be deducted. So you have only 2,83,333 to be recognized now. Okay. To this is your Q2 revenue. Q2 revenue. From this deduct cost. How much is the cost? He has given cumulative cost. Cumulative minus your so cumulative is 3,60,000. Yeah, thank you. 2,10,000. 3,60,000 minus 1,50,000. You get it as 2,10,000. So 2,10,000 would be your cost. So your profit for Q2 is 73,333. Okay. Next, for Q3, by the time Q3 has come, you have completed the project, because he clearly says that Q3 is your Q3 total cost is 4,05,000. That is cumulative cost till Q3, and there is no estimated future cost at all. That means your project got completed. So in Q3, I can recognize 100%. So 100% of 5 lakhs is 5 lakhs. Out of 5 lakhs, already 4.5 lakhs is recognized till Q2. So that means revenue for Q3 would be only 50,000. Revenue for Q3 will be only 50,000, and cost would be 4,05,000 minus 3,60,000, which is 45,000. That is, your actual cost incurred only in Q3. So profit for Q3 would be 5,000. This is such a easy problem. Only thing, you should get the thought that you should do it along with AS7. You should get the thought that you should do it along with AS7 whenever a construction contract is given. Believe me or not, when I was writing CA final exams, one of the attempts, this was a question. And I flunked in that attempt. Okay. So I still remember this. Q2 again, yeah, I'll do that, guys. In Q2, first you're supposed to calculate percentage of completion. How do you calculate that? Percentage of completion is calculated based on total cost incurred till date, which is 3.6 lakhs, which is 3.6 lakhs divided by estimated total cost. Estimated total cost, it gives me 90%. So revenue should be recognized for 90%. 5 lakhs into 90%, it is 4,50,000 revenue, what I should recognize. However, out of this 4,50,000, 1,66,667 is already recognized in first quarter. Hence, that is deducted. So in Q2, what I'll recognize is only 2,83,333. Out of that cost incurred in second quarter alone is 2,10,000. How did I get this 2,10,000? 3,60,000 minus last quarter's 1,50,000. So I have 2,10,000 as cost. Hence, profit for Q2 is 73,333. Okay. All right. So with this, it's done. Let's go to next question. Yeah. We are now entering into taxation part. Please see the question. NDA Limited presents IFR quarterly, earns 600 lakhs pre-tax profit in the first quarter ending 30th June 2015, but expects to incur losses of 200 lakhs in each of the remaining 3 quarters. This will result in zero income during the relevant financial year. Effective tax rate is 35%. Apply AS 25. Now, what is he trying to convey? Whenever a question of this kind is given, you are supposed to take weighted average tax rate mixing. Okay. So in this problem, he says in the first quarter he is going to have more profits, and in the future there is going to be loss which will offset this profit. Eventually, there would not be any tax expense for the full financial year. Okay. So what we are supposed to do is we are supposed to calculate weighted average tax rate, mixing together all whatever expenses, whatever profits you have. Okay. So considering that, let us do this question. So he has given you 4 quarters details, particulars Q1, Q2, Q3, Q4. Profit before tax is 600 is what he says. and there will be loss of 200 every quarter is what he says. So taxation, he already gave you what is tax rate, average tax rate. He has already told you in this question. Please see, effective tax rate he has mentioned as 35%. Okay, so the same tax rate we are supposed to apply. So for first quarter, it's going to be 210 deduction. From second quarter onwards, it's going to be 70, which will be a saving. So automatically, net impact in the financials, what you prepare, interim financials, would be profit after tax for the quarter would be 390 in the first quarter, 130 negative in the second quarter, 130 negative in the third quarter, 130 negative in the fourth quarter also. Q3 reference to which essay should be given? Wait. Q3 is about construction only, no? Yeah, construction, ma. Yeah, A7. In question 3, question 3, it is A7, Pooja. Are you asking about question 3 or quarter 3? Okay, let's go ahead. So whenever he, yeah, so question 3, it is A7 only, construction contracts. All right. So this problem, there is only the solution. So whenever he gives you effective tax rate, the tax rate should be applied such that your annual impact would be 0, or annual impact would be the same 35% on your profits. So this is how you solve when he gives you details of all the quarters with effective tax rate. Okay. Next question. Fifth question, please see. NDA Limited presents IFR quarterly on 1st April 2015. It has carry forward loss of 400 lakhs for tax purpose. It earns 500 lakhs in each quarter ending 30th June 2015, September, December, and March 2016, excluding the loss carried forward. Tax rate is 40%. Calculate tax expense in each quarter. Now, when he gives you details about previous losses and he tells you about the current year's profits, what you are supposed to do is you should first calculate what your effective tax rate is. Now, what does effective tax rate mean? When there are profits which are given for various slabs, like how our Indian income tax works for individuals, same way you are supposed to see what is the effective tax rate for your income. So once we calculate the effective tax rate, we will be able to apply the tax rate on the profit made in each of these quarters. So whenever a question of this kind is given, you are supposed to solve like this. First step to be done is calculation of effective tax rate. Number 1 is calculate effective tax rate, ETR. How do we calculate? He says book profit for 4 quarters is 500 into 4, which is 2000, from which I have a brought forward loss of 400. So my taxable income is only 1,600. On this, tax at 40% would be 640. Okay. So this is what I want. Now, in this year, I am going to pay 640 rupees when I have a book profit of 2,000. So effective tax rate is equal to 640 divided by 2,000 into 100, which comes to 32%. Now he says actual taxation rate is 40, but that's not your effective tax rate. Though you call you are paying 40% tax, in this financial year, you are ending up paying only 32% tax because you are taking effect of previous year's losses in this year. Hence, you are taking the effective tax rate of 32%. Now that you have calculated 32%, you can go ahead and prepare for each quarter. So quarter-wise preparation would be interim financial report. So particulars Q1, Q2, Q3, Q4. You have 4 quarters. For all the 4 quarters, please prepare. Profit before tax given 500 for each quarter. Less tax at 32%. It would be 160. So when you deduct, profit after tax would be 340. So this is your solution. Okay. Next. Let's go ahead with the last question. Any doubts, please ask. This is calculation of effective tax rate. This is your interim financial reporting calculation. All right, let's go ahead to next question. Last question in this standard. An enterprise reports quarterly, estimates an annual income of 10 lakhs, assume tax rates on first 5 lakhs at 30%, on the balance at 40%. The estimated quarterly incomes are 75,000, 2,50,000, 3,75,000 and 3 lakhs. Calculate tax expense to be recognized in each quarter. Now, whenever he gives you such values, that is based on slabs, taxation based on slabs, you're first supposed to calculate weighted average tax rate. Weighted average tax rate should be calculated and then arrive at the correct correct tax rate for your income that is applied for each quarter. Okay, so let us do. Calculation of weighted average tax rate. Weighted average tax rate. So tax rate is given as a percentage. Weight is given. Product is also what we find out. So 30 and 40 are the two slab rates what we have. Weights are for the first 5 lakhs. It is. So please see the total income of that guy. He says on the first 5 lakhs it is 30%, on the balance 40%. In this question, he says 75,000, 2,50,000, 3,75,000 and 3 lakhs. These are his incomes. So total of all this comes to 10 lakhs. 10 lakhs. So what I should now do is I should consider my weights based on the incomes what he has earned. For the first 5 lakhs it is 30%. For the next 40, for the next 5 lakhs it is 40. Okay. So product is that into this, which is 150 and 200. total is 350 divided by weights is 10. So weighted average tax rate, if you see, weighted average tax rate is equal to 350 divided by 10, that is 35%. Okay. Once this is done, you can adopt your tax rates on all the quarters. Now, let us do it here itself. Particulars Q1, Q2, Q3, Q4. Profit before tax given is 75,000, 2,50,000, 3,75,000, and 3 lakhs. Tax at 35%, which is your weighted average tax rate, effective tax rate here. So on 75,000, it's going to be 26,250. On 2,50,000, what is 35%, please? So please take all the 4 columns. That would give you profit after tax. Oh, thank you. 87,500, 131,250, and 1,05,000. So your profit after tax would be 48,750, 162,500. Thank you, guys. 230, 243,750, 1,95,000. Okay. So these are your numbers with this problem. Now, so any doubts? Any doubts you are free to ask. Okay. Now that this standard is over, let me quickly take you through differences between AS and Ind AS. Ind AS number is 34. Number is 34 for interim financial reporting. The first difference is there is no concept of extraordinary item. No requirement of giving breakup of extraordinary items at all in interim financial reports also. Second, along with your balance sheet, P&L, cash flow statement, balance sheet, P&L, cash flow statement, and critical notes to accounts, there is one more important statement to be prepared called as statement of other comprehensive income. Statement of other comprehensive income. This should be prepared along. This should be prepared along under Ind AS only. Under Ind AS only. Okay. So majorly these are the differences. Apart from this, there are no differences in AS and Ind AS in this regard. Okay. And one more aspect is under AS, if there is any contingent liability, we bring it into the statement of in your interim financial reporting. But under Ind AS, contingent liabilities and also contingent assets should be disclosed in the notes to accounts. So these are few important aspects which you need to be careful about while preparing Ind AS. Okay. So that's it. Let's go to next part. Next, let us take up impairment. impairment, AS 28. Now, what does impairment mean? Impairment means fall in value of asset. Fall in value of asset. That means your book value of the asset is greater than, if your book value of the asset is greater than its real value, then we call the assets to be impaired. So whenever the book values are greater than the real values, we test for impairment, and this testing for impairment is not an annual activity. Not an annual activity. It is done only when there are indicators for impairment. Impairment. Only if there are indicators we do, otherwise we do not go ahead for impairment at all. Now, what sort of indicators can be there? There are predominantly two types of indicators. One, external indicators. Second, internal indicators. What are external indicators? External indicators like market conditions have fallen down. There is no new market in this for this product at all, or there is an advanced version for a competing brand. So like that, if you have some information which tell that I would not have value for my asset which is in the books of accounts, in such case we go for external indicators. Internal indicators mean the company believes that the company's performance is not good, and there is a fire which has occurred in the factory which has which has damaged the assets in the company. Such examples can be taken for internal indicators for impairment. So for either of these two, in either of these two cases, what we should do is impair our assets such that the assets would showcase only fair values which exist with them. Okay, so this is the first understanding about how impairment should be done. Now, having said this, how do we test for impairment? What are the various parameters to be observed in this? Now, impairment under AS, let us first talk. Ind AS I'll talk later. Impairment, the standard works for both tangible and intangible. However, with respect to intangible, the other standard, intangible asset standard, is also supposed to be considered while impairing any intangible assets. Okay. Now, when it comes to tangible assets, what is important is assets should be tested for impairment based on these two conditions. First, look for the book value, that is carrying value. Carrying value of the asset is compared with recoverable amount from the asset. Now, what is carrying value? It is nothing but your book value. Book value means the amount which exists in the balance sheet after depreciation, amortization, or any previous impairment losses. That value is what I call as my book value or carrying value. So your carrying value of the asset is compared with recoverable amount. And now, what is recoverable amount? Recoverable amount is higher of two numbers. One is the amount of net selling price minus cost to sell, minus cost to sell, and second, value in use. Second, value in use. Now, what is net selling price and what is value in use? Net selling price means the price at which I can sell this particular asset in the open market is what we call as net selling price minus cost to sell. For example, if I would like to sell away a air conditioner in my office, I will have to incur few costs, like maybe I'll have to dismantle the air conditioner from the wall, then put it in a transporter's vehicle, then send it across to somebody. So there is a cost of say 1,000-2,000 rupees for me to move my air conditioner from one place to another. In such case, that cost is what I call as cost to sell. Okay, so that is what I call as cost to sell. Now, net selling price is the price at which I give away my asset for sale. Now, second, value in use. Value in use indicates what is the value I derive out of this by using this asset over the next few years. So when you compare these two, whatever higher value comes, that would be considered as recoverable amount. And if the recoverable amount is lesser than your carrying amount, only then impairment happens. Let us take an example. Carrying a value of my air conditioner happens to be 40,000 in my books of accounts. Net selling price has come to 25,000. If I continue using this asset, I will use this asset for another 4 years. Every year I will have a utilization of, say, I will have over 4 years. Value in use would be somewhere around 35,000. In such case, the higher of these two will be 35,000. And when I compare 35,000 with 40,000, there is a reduction in value. In such case, I'll have to impair it to 35,000. So my impairment loss would be 5,000. Okay. So my impairment loss in this case happens to be 5,000. This 5,000 is to be charged to P&L, in the financial year in which such impairment has happened. Okay. So predominantly, this is what impairment talks about. Now, in this, we will go deep and discuss what other aspects can happen. Now, impairment is first tested for individual assets, if possible. Individual assets, if possible. Okay. If it is not possible to test it on individual assets, then it is tested on a group of assets which work together. A group of assets which work together, what we call as cash generating units. A group of assets which work together, what we call as cash generating units. What is a cash generating unit? A cash generating unit is a unit which contains various assets in it. When all of those work together, that generates some revenue to my entity. That is what I call a cash generating unit. Now, how should I find out a cash generating unit in my entity? For example, like yesterday's segment reporting example, which I have taken Tata, let me take the same example. So Tata Motors has got multiple segments inside it. Out of that, there could be subsegments also. Out of this subsegments, like that, you can drill down multiple layers maybe. Now, a cash generating unit is that last layer in the entire tree, which can work together and produce some revenue to my entity. How do I identify that? For example, Tata has got its main manufacturing plant in Jamshedpur. Say It has got another plant in Baddi, Himachal Pradesh. Baddi, Himachal Pradesh. It has got another manufacturing unit which manufactures only a small spare parts which are required for all its cars. Now, can I recognize this as a cash generating unit? Yes, because though it is manufacturing only spare parts, it is going to generate revenue by selling its spare parts to all other manufacturers, car manufacturers, lorry manufacturers, truck manufacturers, bus manufacturers, and all. So this one small plant where you have 10 or 20 equipment, machinery, and there is some land and building there. There is some factory facility created. That entire factory can be considered as one cash generating unit. Like this, if you can identify group of assets which work together to generate revenues to a company, then you can identify it as a cash generating unit. Now, having said this, if we cannot impair an asset independently, only then we go for testing of cash generating unit. Okay. So how do we test for cash generating units? So let us keep that aside first. Let's first solve problems in direct questions. Then we will go to the other questions. So take out next page only. Yeah. Please see questions. Question number 1. Yeah. The following information is available for the fixes of the company. Carrying amount in the balance sheet, net of accumulated depreciation, 340 lakhs. Assets are 2 years old. The present market price of the asset is 300 lakhs. Company charges 10% SLM depreciation, assuming 10 years useful life. Estimated useful life of the asset has been reduced to 5 years henceforth instead of remaining 8 years because of technological changes. Market rate of interest has declined. Market rate of interest has declined. Accordingly, there is a decline in the discount factor from 16% to 15%. Book value to market capitalization ratio of the company is 80%. Is there an indication of impairment of assets? So he is asking you from various parameters, that impairment parameters, whether there is indication or not. Okay, so how do you tell? How do you tell? So he says carrying amount of asset is 340 lakhs, and then 2 years old the assets are, and the present market price of the asset is 300 only. Okay, the company charges SLM depreciation, assuming 10 years life. So that means it has already deducted for 2 years depreciation. 2 years depreciation after charging 10%. So that means 20% depreciation is charged off. So today the book value is 340, but the present market value is 300. So when you compare only with present market value is lower only. Okay. That is what we call as net selling price. And estimated useful life of the asset has been reduced to 5 years henceforth. That means whatever I earlier thought of 8 years pending, out of 10 years, 2 years is over, 8 years is only pending. So now it is only 5 years. That means again, that's an indicator that there is requirement for me to charge depreciation further. Okay. And third, market rate of interest has declined. So why is market rate important for us? That is the factor for us to determine at what margins we operate. Okay, so the margin has fallen down from 16% to 15%. That is also an indicator that we should write off our assets. So book value of market capitalization ratio of company is 80% only. So that is not 100% also. It has fallen down to 80%. So considering all these factors, there are indicators which are external. Hence, there is requirement for us to impair our assets. Okay. So he did not ask you how much would be the impairment loss and all, but still you can take it by comparing 340 and 300 and impair 40, and the balance 300 will be written off over next 5 years life, because your life is reduced from 8 years to 5 years now. Hence you are supposed to write off 300 lakhs over next 5 years itself, which is 60 lakhs depreciation every year. So that's the question I've quickly told you. Now let's go to second question. X Limited is having a plant carrying amount of which is 100 lakhs on 31st March 2015. Its balance useful life is 5 years and residual value at the end of 5 years is 5 lakhs. Estimated future cash flows from using the plant in next 5 years are, so next 5 years he has given you cash flows. Calculate value in use for plant if the applicable discount rate is 10%, and also calculate recoverable amount if the net selling price of plant on 31st March 2015 is 60 lakhs. Okay. So he has given you net selling price less cost to sell. He has given you information to calculate value in use. He has given you book values also. So let's start with our solution. So please have the standard template. Number 1 is carrying amount, which he has mentioned as 100 lakhs. Number 2, recoverable amount. In this A, net selling price is given as 60 lakhs. B, value in use. Value in use should be calculated now. He has given you some information for it for 5 years. So year, cash flow, discount factor at that percentage, 10% given, discounted cash flows. So please prepare for 5 years, 1, 2, 3, 4, 5. Cash flows given are 50, 30, 30, 20, 25, 0.909, 0.826, 0.751, 0.683, 0.621, and cash flows, please do and tell me, guys. Amounts, please. I want final value in use. Okay, 118. Okay, I'll take it as 121. Loudest is the answer. 121.94. Yeah, 0.94. Let me take this. So 121.94 is the value in use. Now, highest of these two is to be taken. So 60 and 121. Highest is 121. This is compared with 100. When it is compared with 100, the book value is lesser than your recoverable amount. Hence, there is no impairment at all. There is no impairment loss at all. Okay. So write a conclusion. Since recoverable amount is more than carrying value, no impairment is required. Let's go to next question. Year 5 cash flow is 50. Yeah. Acha. So 50, 30, 30, 20, 20. All right, fine. Please correct otherwise. So in that case, it is 118. No, yeah, there's residual value there, no? Of course, yes. Wherever there is residual value, you take 5 lakhs, no? In the beginning, it is given. Okay. So residual value is there. 5 lakhs has to be taken at the end. So it's correct that it is 25. It's 25. Okay. So it is 121.94. Yeah. So let's go to next question. NDA Limited acquired a machine for 32 lakhs on 30th November 2015. The machine has 5-year life with 5 lakh salvage value and was depreciated using SLM. On 31st March 2016, a test for impairment reveals the following. Present value of future cash flows 1,35,000. NSP is 15,50,000. Salvage value nil. Assuming loss for impairment is recognized for the year 31st March 2016, what should be the depreciation expense for 31st March 2017? So there is a problem which has got a holistic basis. So he is asking you not just about the impairment loss and all. He is asking you what should be done after impairment, post impairment. How should you treat the asset is what he is asking for. So let us do again. Number 1, carrying amount given is 32 lakhs, and then your recoverable amount in that A, it is net selling price is given as 15,50,000. Carrying amount 32 lakhs is not today's value. He has given it as on which date? 30th of November 2015 he has given. So let us work on it. Let us work on it. So B, value in use is mentioned as lakh and 35,000. Out of these two, higher is 15,50,000 only. So net selling price will be considered for comparison. But first we are supposed to calculate carrying amount. Now carrying amount, he says it is done on straight line basis. Yeah. He acquired it for 32 lakhs on 30th November. So the machine has 5 years of life with 5 lakhs salvage value. So he would have deducted 5 lakhs and divided by 5. You get 1 year's depreciation. Out of 1 year, it is only 4 months for which it was there with him for in 2016. So you are supposed to calculate depreciation for 4 months only. Okay. So I'll calculate carrying amount here separately. given as on 30th of November 2016, 2015, sorry, 2015, it is 32 lakhs. Depreciation for 1/12/15 to 31st March 16 is required. So it's going to be 32 lakh minus 5 lakh divided by 5 years. You get for 1 year into 4 divided by 12 years. 4 divided by 12, that would be 1,80,000. Yeah, 1,80,000 correct depreciation. So your carrying amount is 30,20,000. Depreciation is to be calculated and then take carrying amount. Carrying amount comes to 30,20,000. Now, when you compare these two, impairment loss is to be so number 3, impairment loss 1 minus 2 is equal to 30,20,000 minus 15,50,000. You get 14,70,000. 14,70,000 as impairment loss, and this loss is charged to P&L. Charged to P&L. Next, number 4. What is he asking there? What is revised depreciation is his question. Okay. So now your revised carrying amount is equal to 15,50,000. After impairment, whatever is the recoverable amount, that would be your book value. Okay. So revised carrying amount is 15,50,000 and your revised depreciation shall be 15,50,000 minus salvage value. He says revised salvage value is 0. Okay. Divided by 4 years and 8 months or 9 months? 8 months. Divided by 4 years, 8 months. So you can calculate for number of months and then do it per year how much it is. $3,15,000. Is it per year? Okay. So you have got it for per year. It is 3,15,000. It seems. Let me see. $15,50,000 divided by 48 plus 8, 56 months. So per month it comes to 27,678. This into 12. Into 12, depreciation per year would be 3,32,142. Okay. So 3,32,142 is per year depreciation. Yeah, it should not be considered because in the last line he has mentioned about your a clause given there stating that, please see the second page, second part of the question. Yeah, and the first page only, salvage value estimated is nil. Okay, since he has mentioned salvage value estimated is nil, we would not consider anything. Okay, and moreover 3,32,000 whatever answer we got, 143 is for one full year. he is asking you depreciation for full year or only for 31st March 2017. What should be the depreciation expense for the year ended 31st March 2017? So we have done it on 31st March 2016. So as on 31st March 2017, it's going to be for one full year only. Okay, so that should be the correct answer. That's all. So 3,32,142 or 143. Okay. So let's go with next question. Fourth question, please see. Fourth question. Uttaranchal Industries Limited gives the following estimates of cash flows relating to fixed assets on 31st December 2015. Discount rate is 15%. Year and cash flows are given for 5 years. Residual value at the end of 2020 is 500. Fixed assets purchased on 1/1/2013, 20,000. Useful life is 8 years. Residual value estimated 500 lakhs at the end of 8 years. Net selling price 10,000 lakhs. Calculate on 31st December 2015. Carrying amount at the end of 2015. Value in use on 31st December 2015. Recoverable amount on so and so date. Impairment loss. Revised carrying amount. Depreciation for 2016. So first thing important for you here is the financial year is not April to March, it is January to December. So he has given you info about when he has purchased the asset and what is the life which got completed and all. Accordingly, you are supposed to work out for the current carrying amount first. Okay. So let us do that. Number one, carrying amount calculation for 31st December 2015. So he has given you value as on 1st Jan 2013. He mentioned it as 20,000. Okay, 20,000. And depreciation would be 20,000 minus 500, which is salvage value given then, divided by 8 years. 8 years. It comes to, please tell me, I think it's 2,400 something. Yeah, 2438 it seems. 2438. In fact, it is, to be precise, 2437.5. 2437.5. Please take it. Now we want it for 31st December 2015. That means 2013, 14, 15. 3 years passed. 3 years passed. So depreciation for 3 years is equal to that into 3. So it comes to 6,000, 7,000 something. Yeah, 7312.5. So carrying amount as on carrying amount as on 31st December 2015 is 12,687.5. Thank you. 12,687.5 is the carrying amount. So this is the first input which I need. Next, number 2, recoverable amount. For this, he has given you A, net selling price as 10,000, B, value in use you are supposed to calculate. He has given you cash flows, discount factor at what percentage is it? Discount factor is to be taken for 15% discount factor is supposed to be taken. Yeah. So 15% discount factor is to be taken. Cash flows are 2000, 3000, 3000, 4000, and fifth year. Did he tell you about any changes in salvage value? So salvage value, residual value at the end of 2020 is 500 lakhs. So that did not change. He did not tell you about residual value estimated is again going to continue to be same 500. So I'll have to take 500 plus 2000, 2500 for fifth year. Okay, so it is 2500. Okay, so discount factors you will take. Discounted cash flows, please do and tell me what is the value you have got. So you have got 9503, it seems. 9503. Is it 9503 or 9261? Please check correctly, guys. 9503 or 9261. Okay, somewhere around 95 only. So I'll take it as 9503 only. So out of these two, highest is 10,000. Hence 10,000 will be considered for impairment testing. Now let's go to can we take year 8? Sir, that is what he has clearly given in the question. Please see here. Residual value estimated 5 lakhs at the end of 8 years. He has told you residual value at the end of 2020 is 500 lakhs. The same he is repeatedly mentioning. I mean, like the first instance, he has given it to tell you about what he has thought before impairment. The second is basically your restated values. Okay. So in both the contexts, he has mentioned it as 500 only. So hence I am considering it as 500. Okay. So next, number 3, impairment testing. Impairment would be 12,000 something which you told me then. Okay, so it is 12,687.5 minus 10,000, which comes to 2,687.5. Okay, so this is my impairment loss. Impairment loss is 26787.5. So number 4, revised carrying amount would be 10,000. Next, number 5, revised depreciation would be 10,000 minus 500 divided by 5. Minus 500 divided by 5. I get 1900 if I am not wrong. 1900 would be revised depreciation. Okay. So this is the question. This is the answer. So let's go ahead to next question. Can we go ahead with next question, guys? Any doubts? All right, let's read the next question. Fifth question, please see. NDA Limited acquired plant on 1/4/2008 for 50 lakhs, having 10 years useful life, and provides depreciation on SLM with nil residual value. On 1/4/2013, NDA Limited revalued the plant at 29 lakhs against its book value of 25 lakhs and credited 4 lakhs to the revaluation reserve. On 31st March 2015, the plant was impaired and its recoverable amount on this date was 14 lakhs. Calculate impairment loss and how this loss should be treated in the accounts. Now, whenever there is a previous revaluation and post which there is impairment, the amount of revaluation profit, whatever you have, should be first adjusted against this impairment loss. And if that is completely consumed, only then impairment loss will be charged to P&L account. Okay. So in this problem, we are supposed to first calculate what is the book value as on this date. Book value as on this date, that is carrying amount as on this date. Then we will talk about what has to be done. Okay. So number one, calculation of carrying amount as on 31st March 15. Okay. So he has given book value on 31st March 13 as 25 lakhs. Sorry. Yeah. So on 31st March 2013, it is 25 lakhs. And then there is increase in value, which has gone to 29 lakhs. Okay. So for 2 years, he has taken it for 29, depreciation charges for 29 lakhs. Now he says initially it is purchased on 1/4/2008 for 50 lakhs. And it has got a life of 10 years with zero residual value. That means every year he used to charge 5 lakhs of depreciation. At the end of 5th year, when it has become 25 lakhs, he has revalued it again and made it to 29 lakhs. Okay. Add revaluation 4 lakhs. It has become 29 lakhs. On this, depreciation charged for 2 years at 2.9 lakhs. So 2.9 lakhs for 2 years. Sorry, 29 lakhs is for 5 years only. 29 lakhs is supposed to be written off in 5 years, next 5 years. So per year it's going to be 11 lakh, yeah, 11 lakh 60,000. So carrying amount as on 31st March 2015 would be 17 lakh 40,000. So this is your first part. This is your first calculation, what is required. Now let us go to recoverable amount calculation. Number 2, recoverable amount calculation. Higher of A net selling price, which is given as 14 lakhs, B, the other value in use is not given. Hence, I'll take 14 lakhs only as net your recoverable amount. So recoverable amount is 14 lakhs. Carrying amount is 17 lakh 40,000. So impairment loss is equal to 17 lakh 40,000 minus 14 lakhs, which is 3 lakh 40,000. 3 lakh 40,000. Okay. So this 3 lakh 40,000 is the impairment loss. What standard says whenever there is impairment loss and also revaluation reserve is that impairment loss should be first adjusted against revaluation reserve to the extent available for that particular asset. And if there is any balance amount of impairment loss, only that will go to P&L. Now in this problem, you have a revaluation reserve of 4 lakhs for this particular asset. So that 4 lakhs, out of that 4 lakhs, 3 lakh 40,000 can be adjusted against it. And the balance only goes to, if at all there is any amount further to that, then only it goes to P&L. Now, luckily in this problem, the impairment loss is less than 4 lakhs. So entirely you can charge it only to revaluation reserve. So entry for impairment loss would be revaluation reserve account debit to asset account, which is 3 lakh 40,000, 3 lakh 40,000. Okay. Now, after this is done, what would be the revised values? Revised values in balance sheet would be, first, for revaluation reserve, the revised balance would be 60,000, and revised value of your asset would be 14 lakhs, and revised depreciation would be 14 lakhs divided by 3 years is only left now. So every year I'm supposed to charge depreciation at 4.67 lakh. 4.67 lakh every year would be my depreciation going forward. I hope you guys are able to follow. Any doubts, please ask. Okay, let's go ahead to next question. Yeah. So please take out next question, sixth one. A plant was acquired 15 years ago at a cost of 5 crores. Its accumulated depreciation as at 31st March 2014 was 4 crore 15 lakhs. Depreciation estimated for the financial year 14-15 is 25 lakhs. Estimated net selling price as on 31st March 2014 was 30 lakhs, which is expected to decline by 20% by the end of the next financial year. Its value in use has been computed at 35 lakhs as on 1st April 2014, which is expected to decrease by 30% by the end of the financial year. Assuming that other conditions for applicability of the impairment accounting standard are satisfied, what should be the carrying amount of this plant as on 31st March 2015? How much will be the amount of write-off for the financial year ending 31st March 2015. If the plant has been revalued 10 years ago and the current revaluation reserve against this plant were to be 12 lakhs, how would your answer change? If the value in use was 0 and the enterprise were required to incur a cost of 2 lakhs to dispose of the plant, that is NSP is -2, what would be your response to question 1 and 2 above? Now, first of all, in this question, there are three independent questions. The three independent questions are, first and second questions are one question. Third question is a separate independent question. Fourth is an independent question. Okay. So out of these three, first we are supposed to solve 1 and 2. Then only we can go ahead for third and fourth question. Now he says the asset is acquired 15 years ago for 5 crores and till 2014 the depreciation charged is 4.15 crore. So that means my book value as on March 2014 is 85 lakhs. 85 lakhs is the depreciation. 85 lakhs is the book value as on 31st March 2014. But am I testing for impairment on 31st March 2014 or 2015? It is 2015. Hence 2014 is not important for me. From that I'll have to charge further depreciation of 25 lakhs which he has given here. He has mentioned for 14, 15, 25 lakhs is the depreciation. So I'll have to deduct that also from that 85 lakhs, which gives me the carrying amount as on 31st March 2015. Okay. So as on 31st March 2015, the carrying amount would be 5 crores minus 4 crore 15 lakhs minus 25 lakhs. Okay. So net off is 60 lakhs. And then he has given you net selling price as 30 lakhs. That too as on previous year only. So that also you are further supposed to dig down and bring it to present value. And cash flows also he has mentioned as 35 lakhs last year, which you will have to work out to bring it to present year first. So once we are done with that, then we can go for other parts of the question. So let us answer this. Number 1, carrying amount calculation. 500 I am taking in lakhs so that it will be easy. Minus 415 minus 25. So it comes to 60 lakhs. Number 2, recoverable amount. First one is net selling price, which is 30 lakhs, which is given minus 20%. He says currently it has fallen down by 20%. Okay. So that becomes 24 lakhs. And value in use, let me see once again. So it is 35 lakhs on 1/4/2014, which is expected to decrease by 30%. So it is 35 lakhs minus 30%, which comes to 24.5 lakhs. 24.5 lakhs. Okay. Now out of these two, whatever is higher is to be taken. So it is 24.5, which I will take. So number 3, impairment loss. Impairment loss is equal to 60 minus 24.5 lakhs, which is 35.5 lakhs. Okay. Next, revised carrying amount would be 24.5 lakhs. Okay. Now I think till this the first question is over. First 2 parts are over. Now let us come to second part, second question, which he has told you. If there is a revaluation reserve of 12 crores, 12 lakhs, what would I do? if there is revaluation reserve of 12 lakhs, out of this 35.5, I'll first write off this 12 lakhs against revaluation reserve, and the balance only will be taken to P&L account. So in such case, entry would be revaluation reserve account debit 12 lakhs, P&L account debit. It's going to be 23.5 lakhs to asset account 30.5 lakhs. Okay. Last question what he has asked is, what if value in use is 0 and NSP is -2? So that means if value in use is 0, NSP is -2, you should take higher of these two. Higher of -2 and 0 is 0. Okay. That means I will have to impair entire 60 lakhs. I'll have to impair entire 60 lakhs. In such case, it is impair fully. That is 60 lakhs. So this is your answer. Okay. So it's 1 o'clock. Let's take a short break for lunch. We'll catch up by 1:45 again, and go ahead with cash generating unit problems, and then start with consolidation. Thank you. Yeah, let's start back, guys. So I sorry that if I troubled you by giving the break a little in advance. Only my intention is so that we will go seamlessly with the flow when we finish it off for each part. So I thought I'll start afresh cash generating units topic. So that's the reason why I gave a break well in advance. So let's start with our discussion. Let's move to cash generating units. What is a cash generating unit? First of all, as we earlier discussed, whenever we have a group of assets working together to generate revenues to an entity, then you call that group of assets as one cash generating unit. Why is this concept required? It is required because many times individual assets in the company assets might not be able to generate cash for the company, in which case your identification of value in use is difficult. Hence, when it is not possible to identify individual value in use, we would try calculating impairment loss for the group which perform together. So that is the reason why we test for impairment for the group of assets together. Now, having said this, how do we do impairment testing for the group? So whenever impairment testing is done for the group, all assets in the group will have a proportionate impairment. So this is what happens when we test for the group as a whole. Now, what does proportionate impairment mean? Proportionate impairment means when, say, 10 lakhs is the existing book value of 4 assets together, and there is an impairment loss of 2 lakhs. So 2 lakhs will be distributed to all the 4 assets based on their values. Now, on what proportion should I charge this impairment against each of this asset? Standard says whenever impairment is being tested on a group, the assets are to be impaired on a proportion based on their original cost, which means older historical cost, whatever we have initially taken them into books of accounts, that should be considered, and you are supposed to take. Okay. Now, there would be situations where a particular group of assets may have goodwill. What does that mean? While purchasing a group of assets, I have paid some goodwill and then bought a cash generating unit. That means I have bought a business by paying some goodwill. In such case, if that goodwill in the balance sheet can be allocated to a specific cash generating unit, such goodwill will be first written off, and then the balance assets will be written off based on original values. So this concept is what we call as bottom up test, bottom up test, which means from the bottom you'll try to observe for each cash generating unit, can you allocate the goodwill or not? If that is possible, you will first allocate goodwill to each of these cash generating units and then test for impairment. If this is not possible, or after doing this bottom up test, there are some other cash generating units to which you cannot allocate the remaining goodwill. For those, there is something called top-down test which is applied. Top-down test which is applied, where you will consider the rest of the goodwill as first priority to knock off, and the balance would be charged against the assets in the other CGUs, and this is the basis for you to write off impairment loss against each of these assets. I'll repeat once again. Whenever you have cash generating units, the impairment loss will be attached to each of these assets based on a proportionate basis. That proportionate basis will be, that mathematical proportion would be balance sheet values. It's not balance sheet values. It is acquisition, as on acquisition date, original values, whatever price we have purchased, that would be the basis. Second, if there is goodwill inside the balance sheet, goodwill will be first allotted. If it is identifiable to a specific cash generating unit, that will be first added to that cash generating unit, and then impairment testing is done. Later on, if there are any further cash generating units to which goodwill cannot be allocated, then it would be commonly written off by doing, then it is tested for impairment commonly, and first goodwill is written off, and then balance amount of impairment loss, if any, will be charged to other cash generating units. So this is how we do. You will get more clarity as we do problems. So let us take up next question. So 7th question, please see. These two questions are theory questions. A mining enterprise owns a private railway to support its mining activities. The private railway could be sold only for scrap value, and the private railway does not generate cash inflow from continuing use that are largely independent of cash flows from the other assets of the mine. Identify CGU. Now here the question is about whether I can impair my railway line independently, is the question, or should I add it to my cash generating unit and then impair it. Standard says if you cannot independently identify the value, you are supposed to identify the value along with the group of assets in which it operates. Now in this case, railway line by this mining company cannot operate on its own because it's not a railway company. Okay, so it cannot operate on its own, and it is useful only as a support for mining business. Hence, it should be tested for impairment only on a CGU basis, but not independently. Okay, so this is the answer for this. Next. Eighth question. G Limited purchased a machine on 1/1/2014 for 50 lakhs, having useful life of 5 years. On 31st December 2015, its carrying amount is 30 lakhs. Due to fire in the factory, there is some damage to the machinery, but still it is working. Its net selling price on 31st December 2015 is 22 lakhs. The machine does not generate independent cash inflows from use. The smallest group of assets that include this machine generates cash flows largely independent of other assets. The carrying amount of the group of the assets to which this machine belongs is 200 lakhs. The recoverable amount of the group of assets to which this machine belongs is 220 lakhs. Calculate impairment loss for the machine. Okay, so here it is. he is talking about an individual asset. However, that particular asset does not have its own cash flows. So that means value in use for this asset independently cannot be identified. So how should we test for impairment is the question. Standard says whenever you have sorry guys, whenever you are not in a position to identify your uh, cash flows independently, you should test for the group as a whole, that is for the CGU as a whole. Hence, let us do for the CGU as a whole. Now carrying amount for CGU, he has given us 200 lakhs. Recoverable amount of CGU, he says 220 lakhs. So the moment it is 220 lakhs, impairment is nil. Impairment loss is nil, because though this particular asset has caught fire, though this asset has particular asset has caught fire, it is still able to generate cash flows. That particular CG is able to generate cash flows. Hence, there is no impact of impairment at all. Okay, so this is what we are supposed to write for this. Okay, so let's go to 9th question. On 31st March 2013, MMDA Industries Limited acquired X Limited for 600 lakhs. X Limited has 3 cash generating units ABC with net assets of 240 lakhs, 160 and 80 lakhs respectively. MMDA Industries Limited has recognized goodwill of 120 lakhs in its books. For the accounting year ended 31st March 2013, CGUA has incurred substantial losses and its recoverable amount is estimated to be 270 lakhs. The carrying amount of the 3 CGUs as at 31st March 2014, after considering changes in assets in the year 2013-14 and 14-15, are as follows. So there is assets value given, goodwill which is given. Calculate impairment loss to be recognized in the financial year financial statements if goodwill can be allocated on reasonable basis. Second, goodwill cannot be allocated to cash generating units, and subsequently the larger CGU comprises all the 3 CGUs whose recoverable amount is 680 lakhs. So he has directly told you both bottom up and top down questions. Okay, so let us do this. Like how I mentioned, scenario 1 is goodwill can be allocated. That means it's gonna be top down, bottom up test. Okay, now scenario 1, Yeah, sorry guys, a small disconnection. Yeah, scenario one. Goodwill can be allocated. Now, he has given you balance sheet dates uh, as on 31st March 2013 and also 31st March 2015 dates are given. So let us take both balance sheets on 31st March 13 date. Our goodwill is given as 120, CGU A, B, C. There are three CGUs, 240, 160 and 80. This information is required for us for a later period. And with respect to on 31st March 2015, your goodwill is 24. That means the balance amount is written off. So CGU A is 260, B it is 240, C it is 160. C it is 160. Now for calculating for writing of goodwill, what would be my basis? The basis would be original cost of my assets. That is, earlier when I took over this goodwill, the values of my assets in each of the CGUs were 240, 160, 80. That only will be my basis. Okay, taking that as the base, I would write off goodwill against these assets. That is, any impairment will be first written off against this in this ratio. Okay, now let us do how it's going to be. So goodwill of 24 should be attached to ABC in this ratio. So I will do it here. Attachment of goodwill. Attachment of goodwill 24. So to A, the basis would be 24 is to 16 is to 8 is my basis to attach goodwill. So for A, it is going to be 24 into 24 by 48. The total of all these three is 48. So 24 into 24 divided by 48, which comes to 12. For B, 24 into 16 divided by 48, which comes to 8. For C, it is 24 into 8 divided by 48, which comes to 4. Okay. So this is my attachment first. Now, once this is done, we can go ahead with bottom-up test. Whenever we have testing, please adopt like this. Bottom-up test. Now, first of all, for which he has asked you to do for which CGU. So for A, we are supposed to do first. Okay. Yeah, for A, he has asked us to do. A, it is 260 right now. And I have allocated a goodwill of 12. Okay. So write it like this. CGU plus goodwill. CGU is 260 given plus 12 is what I have. Now carrying amount of the this particular CGU is 272 in total. That is 260 plus 12. And recoverable amount, he has mentioned it as 270. That means impairment loss what I have is 2. Now out of this two is to be first adjusted against goodwill. This two is first adjusted against goodwill completely, because I have goodwill in my books of accounts. I'll first write it off. Okay. So entry in that case would be impairment loss account debit to goodwill account. It is 2 and finally it goes to P&L. That impairment loss goes to P&L. Okay. Now post this entry, what would my balance sheet look like? My balance sheet looks like this. My goodwill would be, initially it was 24 in 2015. Okay. Balance sheet on 31st March 2015. It would be after impairment, goodwill would be 22. How did I get 22? 24 minus 2. And CGU-A continues to be the same 260. CGU-B continues to be the same 240. And C is 160. Okay. So the same values will repeat after impairment also. What has changed is only goodwill. Okay. So this is under bottom up test. What if it is top down test? What if it is top down test? So scenario 2, top down. As I told you, in a top down test, you do not know for which CGU you are supposed to cut and attach the goodwill. Hence, you have kept it aside. Now we will do it here. If it is top down test, all the CGU assets should be taken. So CGU plus goodwill should be taken independently. You have 260 plus 240 plus 160 plus 24 you have. And carrying amount, he says it is 684, which is nothing but total of all this. And recoverable amount is only 680, which is given in the question to you. And when you compare these two, impairment loss, what you got is 4. Impairment loss, what you got is 4. This 4 will be first knocked off against goodwill. Okay. In such case, entry would be again impairment loss account debit to goodwill account 4 and the balance sheet after impairment. The balance sheet after impairment would be goodwill 20, A 260, B 240, C 160. Okay. Now, for example, I'm just extrapolating this situation. I'm just extrapolating the situation. Instead of 4 lakhs of impairment loss, what if it is 44? What if it is 44 instead of 4? How would that differ? Let us see. Okay. If impairment loss is 44 instead of 4 lakhs. Now what happens is, out of this 44, first goodwill will be written off for 24. Okay. Goodwill will be written off for 24. And then the balance 20 will be written off over each of this CGU ABC in the ratio of their existing book values. Please mind, only in bottom up test, we go by original cost of the assets. But under top-down test, we go by existing book values. What are existing book values? 260 is to 240 is to 160. This would be the ratio if it is top-down test and still you have amount. So let us do that. So CGU plus goodwill, it is 260 plus 240 plus 160 plus 24. Carrying amount comes to 684. Recoverable amount is, if it is 44, it comes to 640. And impairment loss is 44. Because he did not give us data for others. Kritika. If he gives you data for others, you can do for others also. Okay. Yeah. Now in this question, out of this 44, first preference is you will write off 24 here. Okay. Second preference is out of this, you will write off for each of these. You will write off for each of these based on a proportion. What is the proportion? 260 is to 24 is to 160. So for 160, the amount would be 20 into 16 divided by, total of all this would be 50, 66. 16 divided by 66. For this, it is going to be 20 into 24 divided by 66. For first CGU, it's going to be 20 into 26 divided by 66. Okay. I hope this is clear. There's an extra scenario which I am telling you. Extra scenario. What if impairment loss is 44, but not just 4? In such case, first 24 will be completely written off over goodwill. Then the balance amount will be written off over existing CGUs based on the existing book values of the assets. Please mind, this is top-down method. Under top-down method, you will go by current book values only. Only in bottoms-up test, you will go by original values while splitting the goodwill. That's all. Okay. So this is what you are supposed to do in case it is goodwill. Okay. Now, there is one more important concept I'll explain here itself. What if there are other assets which cannot be allocated on a same, which cannot be allocated to any of the CGUs? That is, say the company has got 3 factories. However, apart from these 3 factories, company has also got a corporate office which takes care of all the corporate matters. And there is one more, there are other buildings which are used by the company. These cannot be specifically assigned to any of these three cash generating units. In such case, what would we do? In such case, the amount of impairment loss, the amount of impairment loss, you will consider this. You will consider this asset as part of your cash generating units, and then write off this along with the other assets. Okay. So when we do a problem, you'll understand this better. So please see the question. 10th question. Rahul Industries Limited has 3 cash generating units ABC. The carrying amount of assets as on 31st March 2015 of A, B and C is 400, 600 and 800 lakhs respectively. Due to adverse technological changes affecting activities of the company conducts an impairment test of each of its CGU on 31st March 2015. The company has corporate assets comprising head office building of 600 lakhs and research and development center of 200 lakhs. The carrying amount of building can be allocated on reasonable basis, but R&D center cannot be allocated on reasonable basis to the cash generating units. The remaining useful life of CGU A is 10 years, B and C is 20 years. The head office assets are depreciated on straight line basis. The net selling price of each cash generating unit is not determinable. Hence, recoverable amount is based on value in use. 15% discount rate is to be considered. Calculate impairment loss to be recognized in financial statements of the for the year ended 31st March 2015 and allocate and allocation of impairment loss. Also calculate the revised carrying amount of assets of all cash generating units. Future cash flows for A, B and C and for the company as a whole at the end of 31st March 2015 is as follows. So for each of the cash generating units, for 1 to 5 years he has given, 6 to 10 years he has given, 11 to 20 he has given. Okay. So this is your total question. Let us first jot down the important points in this problem. Then we will start with the solution. Now he says in the balance sheet, you have your assets like this. Head office building is 600 and he says this is allocable. Okay. And you also have R&D center, which is 200. This is non-allocable. Okay. CGUs, there are 3 CGUs, A, B and C. A has a life of 10 years, B has 20, C is 20. So it is 400, 600 and 800. Okay. Now, whenever you have a question containing both allocable and non-allocable, be it goodwill or even if it is other assets, in either of the cases, first you are supposed to perform bottom-up test. Only after completing that, those would be your basis for top-down test. And again, you will conduct top-down test. It is the same format which you are supposed to follow, even if there is goodwill or even if there is some other asset which is not allocated to, which is not specifically given for a CGU. Okay. Now, with this intro, let us see how we can do for each of these assets. Now, he has told you that for each of this cash generating unit, these are carrying amounts, and he has told you net sale price is not available. So all that you are supposed to do is arrive at fair value, which is recoverable amount, value in use, through value in use. So for value in use, he has given you details of cash flows, and also he has given you details of the discount factor, which is 15% if I'm not wrong. Okay. So please see here, value in use, 15% discount rate is to be considered, and you are supposed to consider these numbers to calculate value in use for each of these entities, each of these CGUs. So please calculate for each of these. For A, it is going to be only two categories, that is 1 to 5 years and 6 to 10 years. For B, it is 1 to 5, 6 to 10 and 11 to 20 also. So considering that information, please do. Please do. You can take annuity factors from 1 to 5 years, and then 6 to 10 years, and then 11 to 20. If you calculate annuity factors once, that's sufficient. You can use for all the three. Please calculate value in use for each of these, for A, B, C, and also please compute for the company as a whole. We will need this at a later stage. We will need this at a later stage when we do top-down test. When we do top-down test, we will need this, but calculation, please do now itself and keep it aside. Please tell me for each of these, what are your numbers? For A, value in use, please tell me. For B, please tell me. C, what is it? And for the company as a whole, what is it? So someone please tell me. So for A, it is 802.68. Thank you, Shiva. So for B and C and the company as a whole also. So for C, I have calculated, it is 1087.52. Okay. So for B, it is 653. Okay. 653.59. C is 1087.52. So for company as a whole, please tell me. Okay. So for company as a whole, it is 2543, it seems. Did you do it independently for with the values given here, or you have summed up these three? I don't think it is 2543. Please check once again. For company as a whole. All right. So it is, yeah, 2876.63 is for the company as a whole. Fine. Let us consider these values and now go ahead with solution. Now, these are your values in use for each of these independent cash generating units and the company as a whole. So let us use this. As I told you, whenever there are both allocable and non-allocable assets, first you are supposed to do using allocable and then finalize there. Only then you should start doing non-allocable. That is, top-down test should be done. So let us start with allocable. So part 1, bottom-up test. Bottom-up test. Now for bottom-up test, you need a basis to allocate this amount of corporate building, whatever you have. So head office building is 600, which is allocable. That should be allocated on a reasonable basis to each of these assets, yes or no? So you need a basis for it. So basis has to be calculated. Basis is to be calculated based on number of years of use by them. Now in this question, CGU A is useful only for 10 years, but B and C are useful for 20 years. So if I take directly the amounts, whatever is given in the balance sheet, it would not give me a proper ratio at all. So what we will have to do is, we will have to take a weighted average based on the number of years for which it would be there. So it's going to be 400 into 10 is to 600 into 20 is to 800 into 30 into 20. So this gives you a ratio of 4,000 is to 12,000 is to 8 into 20, it is 16,000. So it's going to be 4 is to 12 is to 16. This is my basis for allocating your corporate building, head office building, whatever you have, of 600. I hope you guys are able to follow. We are talking about this part, head office building, whatever we have here. I need to allocate it to each of these CGUs, and only then I can start working towards bottom-up test. Okay. So in such case, so for CGU A, share would be 600 into 4 by 32, which comes to 75. Next, for B, it is going to be 600 into 12 by 32, which comes to 225. For C, it is going to be 600 into 16 divided by 32, which comes to 300. Okay. So these are the values which I am supposed to add it to the assets, add it to each of these CGUs, and then test for impairment. Okay. Now, let us go ahead with bottom-up test now. Let us go ahead with bottom-up test. So again, the same format. Format is CGU plus HO building. Here you don't have goodwill to write off goodwill wholly. You only have CGU plus HO building, and then you have carrying amount, total carrying amount, recoverable amount, and impairment loss. Okay. Now, for CGU A, let us first do. For CGU A, let us first do. You have a CGU value of 400 given, and HO which is allocated from the last part is 75. So your total carrying amount is 475, and you have calculated that your recoverable amount is 802.68. Okay, 802.68. So in which case you don't have any impairment loss. Luckily, your carrying amount is less than your recoverable amount, hence no impairment loss in this particular CGU. Okay. Now let us go to CGU B. For CGU B, you have a carrying amount of 600, and the HO allocation was 225. So totally I have 825, and my recoverable amount for B is 653.59. So that means I have an impairment loss. Okay, I'll take this as 654 just for ease of calculation. I have a impairment loss of 171. Yeah, thank you. 171 is my impairment loss. Now this 171 should be allocated to both head office and CGU assets. This is not goodwill to write off entire impairment loss to HO building. Okay, so we'll have to take it only on a proportionate basis. So the basis would be based on their existing book values. So that means against 225, the amount of impairment loss to be charged is 171 into 225 divided by total of these two, which is 825. Same way for CGU assets, the impairment loss to be taken would be, first of all, please tell me the value here. 171 into 225 divided by 825. And in the same way for CGU assets, the loss to be charged is 171 into 600 divided by 825. So for HO building, I'm supposed to, I'll take it as 47 round off. 47 for HO building, and others it would be 124. 124 should be written off against CGU assets. Okay, so this is how we do in case it is bottom up test. Now we have one more CGU C. One more CGU C. Let us see for this. It has got 800 as assets plus 300 is allocated HO cost. Total comes to 1100. Out of this 1100, I have a book value of, I have a value of only 1087.52. I'll take it as 1083, 88. Okay, so my impairment loss here comes to 12. Impairment loss comes to 12. Now this 12 has to be allocated to HO building and CGU based on their proportion. So how would that work out? Out of this 12 to HO building, it's going to be 12 into 3 divided by 11, which comes to, okay, 3. Okay, and out of this 12 for 800, 12 into 8 divided by 11, it comes to 9. I'm rounding it off. Thank you. Okay, So this is the loss which I'll have to account for. Now, having done this, let us now write entry for bottom up test. Okay. So if you observe, in total, the impairment loss is 171 plus 12. 171 plus 12, which has come to 183. 183 is my total impairment loss. Let me write entry for that. Entry would be impairment loss account debit. (183) to A, B, C, and building, which is HO building. Okay. So this 183 is to be, first of all, for A it is nil. For A it is nil. For B it is 124. For C it is 9. Okay. And for building it is, so 3 plus 47, it is 50. Okay. So this would be my entry for impairment loss. Now, after this part is done, what is the balance sheet position? Let us see. Balance sheet after bottom up test. After bottom up test. So you have a HO of 550, R&D of same 200. A did not change. A is same 400. B, there is a huge hit. It has become 170, 476. C has become 791. This is my position now. Now what standard says is, only after you finish bottom up test, you should go for top down test. Now for top down test, what we are supposed to do is, we are supposed to adjust for all the CGUs together along with R&D. Now here, top down test now. How do I do top down test? Please take CGU amounts for all the assets. Okay. So it is going to be 400 plus 476 plus 791 plus 550, that is your HO building, plus R&D 200. Okay. So total value of the carrying amount is, luckily 2417 is the total, and your recoverable amount is greater than that. Recoverable amount you have earlier mentioned to me as 2876. 2876. Okay. And then impairment loss in this case is nil. Okay. Impairment loss in this case is nil. Now let me extrapolate the problem and then do. What if the impairment loss existed? Say, I think with this problem is actually over. With this problem is actually over. I'm now giving you an additional scenario so that it will be like we have tested in holistic manner. What if your recoverable amount was 2000 only? In such case, you will have a impairment loss of 417. This 417 should be charged to each of this based on a proportion. What proportion? Same proportion. In the same proportion, you are supposed to charge impairment loss. In the same proportion, you are supposed to charge impairment loss against each of these assets. Against each of these assets, you are supposed to charge impairment loss. Okay. So this is how we do. If you have a question having head office or other assets which are allocable, not allocable, and all. If it is goodwill, goodwill only will be first completely impaired. But other assets you cannot impair like that. Other assets cannot be impaired because they really have some value with them. Goodwill, since it is intangible, we first write it off completely. But other assets cannot be done. Any questions, please ask. Any questions, please ask. With this, we are done with impairment standard. We are done with impairment standard. Any questions, please ask. Then I'll go ahead with the differences between this standard and Ind AS. Then we will start consolidation. Any questions, please ask. Okay, let's go ahead with next part. In top down, the CGU value should be taken. Not really. In top down, you are supposed to take the revised values. Tanya, that 400, 600, 800 for ABC is before impairment. First bottom up test should be done. Whatever values you have, only those should be considered. If that is not taken, if the revised values are not taken, what's the point of doing a bottom up test? Okay. Yeah. So let us go ahead with comparisons with Ind AS. Fairly speaking, there are a lot of comparisons between this and Ind AS. AS, it is 28. Ind AS, it is 36. Okay. Now, under AS, you have these words called bottom up and top down. These words do not exist at all under Ind AS. However, the method what you adopt is the same. The method what you adopt is the same, but naming wise, the language is not at all mentioned here. Next, AS 28 draws insight from AS 26 for impairment of goodwill. And they will be tested for impairment. In AS 26, what it says is goodwill which is generated out of amalgamation, that is your purchased goodwill, is supposed to be written off over 5 years. That is what it says under AS 14. Under AS 14 it says. However, under Ind AS 103 business combinations, or under Ind AS 36 which is impairment, or under the other standard with respect to intangible assets, nowhere standard tells you that it is supposed to be written off in 5 years. It tells you on every balance sheet date, you are supposed to test for goodwill. You're supposed to test for goodwill. So goodwill under AS, it is 5 years you are supposed to write it off. This 5 years does not exist at all. 5 years does not exist at all. It is to be tested on every balance sheet date. Every balance sheet date for impairment. Second, there would be few intangible assets. There would be few intangible assets whose life is not predictable. Whose life is not predictable. AS 26 says go with a reputable presumption that such intangibles will be written off over 10 years. That is a reputable presumption under AS. However, under Ind AS, any such intangible assets whose life is not expected or predictable, such intangible assets should be tested for impairment, on every balance sheet date. That means every year you should check whether there is impairment loss on this particular asset. So there is no concept of amortization under Ind AS for intangibles on every balance sheet date. I mean, like specifically for intangibles which are goodwill and intangibles whose value in use cannot be identified in life. Okay, number of years cannot be identified. In such case, you will have to test for impairment on every balance sheet date. Okay, so these are few important aspects which you need to be cautious about while testing. Okay, so with this, let us go ahead to consolidation. Consolidated financial statements. I'm sure you all know little basics of consolidation, and moreover, solving consolidation problem. There are many who use different methods. I will go with the method which I adopt. If you feel you are comfortable with it, you can go ahead with it. If you are not comfortable, I will you can do on your own method, but still the concept does not change, or the answers do not change in whatever method you adopt. Okay, so I have picked up that easy method in which it would be easy for us to solve steps quickly. Okay, so let us start with consolidation. First of all, with respect to theory part, consolidation under AS is purely de jure based. I believe I have mentioned about these words in the beginning of this sessions. De jure indicates it is purely rule based. What are rule based here? If I have control over the entity due to my shareholding, that is due to my majority power in voting rights. If I have more than 50%, then only I call it as majority. Not really. Again, comparison only. Pooja, Ind AS 115 and 116 we will discuss later, but I will do that. Don't worry. Not fully applicable for you. It's leases and revenue as per old standard only, but you are supposed to get equipped with comparisons. Yeah. So if I hold a voting power greater than 50%, then I call myself to be having a control in the entity, or control can be through composition of board. That is where I will be where I will be able to control the composition of board of directors. That is, most of the directors in the board will listen to whatever I say. In such case, that is called as composition or control over the composition of the board. Thirdly, I have that relationship with the other entity where it is subsidiary. In such case, we call it as control. If these three conditions get satisfied, if either of these three conditions get satisfied, I call myself having control over the other entity. Only then consolidation will hit in AS. Okay. Now, when you compare this with Ind AS, under Ind AS, the conditions are purely qualitative. Conditions are purely qualitative. That means they are more de facto based. De facto based. What is de facto? More based on facts rather than rules stating that you should at least hold 51% and all. Okay. Now, to explain what this facto is, I'll give you a couple of examples. Say there is company A Limited, in which there are 3 shareholders. Shareholder A, B, and C. There are 3 groups of shareholders. A holds 40%, B holds 30%, C holds 30%. However, for any decision to be taken, A will hold majority here. Hence, A will be called as the controlling entity here, because the other 2 independently they will not be able to control. Of course, jointly they can control, but still independently they cannot control. And it is observed from the facts that these 2 guys are rivals. These 2 guys are rivals, and they both do not come on a single word together. So in such case, A can be considered as controlling entity of A Limited. Okay. Another example, if you see, take B Limited. There is this guy called A, who is a small shareholder, 1% holder, and there is another guy called B, who holds 99%. However, the company B is being operated by A. Any important decision is taken by A. Any activity to be done in B Limited is done by A. Only thing what B did is he has just pumped in the money. That means, except for monetary benefit which B Limited got from B, nothing else is belonging to B. In such case, A only will be called as controlling entity in this case, and A only will have to consolidate B Limited if at all consolidation is applicable. So like this, there are many examples which can be explained in Ind AS. However, not required too much for you. Hence, let me limit this discussion here. Now, let us go directly into consolidation. For you, consolidation comes in multiple phases. There are few common adjustments which are seen almost in all problems. One such common adjustment is URP, unrealized profits. Second, dividend adjustments. Third, there could be bonus issue, and there could be other adjustments like intercompany owings, etc. So these are commonly seen adjustments in consolidation. Along with this, there would be problems with respect to chain holding, triangle holding, cross holding, then multiple subsidiaries, like this. There can be any number of scenarios. Now, what we will do is, I have picked up couple of questions such that all these get covered in a single shot, and we will try solving one problem for each of these, so that you will have clarity on what has to be done. Okay. Now, I will first tell you the format in which I solve the problem so that it doesn't look awkward or new to you. So that if you like that, you can adopt the same. Otherwise, you can go with your own existing method, whatever you're following. So the steps for consolidation, there are three important pieces of information which you should gather. Date of consolidation, date of control, third, shareholding pattern. Shareholding pattern. These three pieces of information are mandatory for any question. After which, there is step 1, which is analysis of net worth of subsidiary. Analysis of net worth of subsidiary, in which we will analyze the net worth into two categories, which is C and R. All your items in net worth would be taken, that is equity share capital, which is always a C item, capital item. Then reserves would be checked for how much has been accumulated by this company before my entry in this company and after my entry into this company. That is, whatever profits are held by the company before my date of control in this company are called as pre-acquisition profits. Hence, it is capital profit for the company. And revenue profits are something which are earned by the company after my investment into the company. That is revenue profits. So all reserves would be taken, and then unrealized profits, if any, will also be brought into books of accounts. Now, at this juncture, these would be totaled and split between holding company and minority interest in their ratio. Holding company and minority interest in their ratios. Okay, so this is first step, analysis of net worth of subsidiary. Then number 2, second is calculation of minority interest. Minority interest is nothing but from step 1, if you add up these two, that is sufficient. So it is going to be capital profits of minority interest and revenue profits of minority interest. Both are from step 1 only. Next, step 3, cost of control. Cost of control calculation is going to be investment by holding in subsidiary should be taken. This is identified from holding company's books. This is identified from holding company's books, less share of capital profits. This is taken from step 1. Step 1, that is here. This is your share of capital profits. The same is taken here. Okay. So when you strike off, you either get a goodwill or capital reserve. You get a goodwill or capital reserve. Next. Step 4, reserves for CBS. Reserves for CBS, in which you will maintain a particulars column and have so many number of columns based on number of reserves, reserves you have. Say for example, you have general reserve, one column for general reserve. You have P&L, you have take one column for P&L. Capital reserve, please take one column for capital reserve. Like that it goes on. Okay, based on number of reserves you have in both the books, you take so many number of columns. And in this, holding companies reserves would be taken as it is from their books of accounts. And second bullet point, subsidiary companies reserves will be taken from step 1. From step 1, whatever you have will be taken. And then there would be adjustment for URP downstream, if any, in the books of holding company. And finally, the total whatever you get will be your reserves for CBS. This is for reserves for CBS. And last part of the problem would be consolidated balance sheet, which is prepared for both the companies together. However, share capital would only be holding company's share capital. Reserves will be coming from step 4. Non-current liabilities will be holding plus subsidiary together. Current liabilities will be holding plus subsidiary together, subject to intercompany owings. I'll repeat, Nandini. I'll repeat. Don't worry. Okay. Assets holding plus subsidiary together, and any intangible assets, that is your goodwill or whatever, will be holding plus subsidiary. Any other non-current assets, again holding plus subsidiary. One important aspect here is investments made by H&S should not come. Investments made by H&S should not come. Only because that is removed, you will have either a goodwill or capital reserve in your balance sheet. Okay. And then current assets, holding plus subsidiary. So this is how your consolidated balance sheet is prepared and total gets tallied. Now let's come back to step 4, reserves for CBS. You would take holding companies reserves, whatever is given in H Limited books. H Limited books reserves would be taken as it is. And then subsidiary reserves would be taken from step 1. What is step 1 subsidiary reserves? That is my share of subsidiary reserves in S Limited, my share of revenue profits from subsidiary. This is the part. I'll highlight in some other color, yellow. So this is what my reserves from subsidiary is. These will be added here. And then any adjustment for URP downstream, would be done here in P&L if exists. Okay. And then finally you total all the columns, and a grand total whatever you get here will be taken to your balance sheet. So these are your broad steps what we adopt in consolidation. Now let me first explain each of the aspects which will impact your consolidation. Number 1, URP transactions. What is URP? URP means unrealized profits. These unrealized profits can happen when there are transactions between holding and subsidiary, and the company holds some of the assets or assets in the balance sheet. Now, for example, predominantly in the questions, if you see, URP happens through inventory. Doesn't mean it should not happen in other assets. It can happen, but it happens predominantly in inventories. So I'll tell you what URP is. URP is of two categories. One is called as upstream and URP downstream. That means upstream indicates if subsidiary company sells goods to holding company, then you call it as upstream transaction. If holding company sells goods to subsidiary company, it's called as downstream transaction. Now, when an upstream transaction happens, that is subsidiary has sold goods to holding company, in which case subsidiary would have made profit on that particular transaction. Profit is made by subsidiary in the transaction. If it is downstream transaction, holding company would have made profit in the transaction. Right? Now, these profits are not actually important for us. What is important is in their independent balance sheets, say if subsidiary has sold goods to holding company, in holding company, if the holding company holds those assets as on the date of consolidation, that is actually when I have to adjust for URP. Why am I doing this? I'm doing this because this value, whatever is shown by holding company in its books, is not at cost. It is at cost plus a margin which subsidiary has added while selling to holding company. Right? While consolidating, I'm going to add this stock along with the stock of subsidiary. So what happens in the consolidated financial statements? I will have some stocks which are at cost, that is subsidiary stocks which are at cost. I will have some stocks which are purchased from subsidiary which are not yet cost but yet at a profit. Okay, there is an element of profit included in this stock. Hence, there is requirement for me to eliminate that profit element in the stock. That is the pure purpose of eliminating unrealized profits in the whenever consolidation is being done. Now, how do I eliminate? If there is profit element in this stock, in the balance sheet of subsidiary, there would be profit in the P&L. Yes or no? There would be profit in the P&L. Hence, while there is upstream transaction, that is in subsidiaries profits, there would be in the P&L, there would be profit with respect to this stock sold. We are supposed to eliminate to that extent of profit. Okay. Same way, let us see in case of a downstream transaction. In a downstream transaction, you will have sale being done by holding company to subsidiary. That means in subsidiary's balance sheet, the stock is overpriced. That is, it is being showcased at a sale price but not at cost. When I consolidate, one stock would be at cost. The stock which has come from subsidiary will be at market price, which is not correct to be done. Hence, to ensure both are shown at cost, this stock will be brought to cost. And at the same time, in H Limited's P&L, there would be profit which is existing. That profit also will be removed in step 4. This is what we do in case of a URP transaction. I hope I made it clear. Any doubts you can ask. Then I'll go to next point. Any questions you can ask? Balance sheet URP. Yeah. So I'll tell you once again, please see. If it is upstream transaction, the profit will be in P&L account of subsidiary. And also the profit will be in, I'll show you through a highlighter, please see. In case it is upstream transaction, the profit will be in P&L account of subsidiary. And at the same time, the profit will be in inventory of holding company. In both these places, I'll have to deduct it. Okay. Hence, what we do is in step 1, when we analyze reserves of, when we analyze net worth of subsidiary company, you would deduct unrealized profit, if any, in step 1 itself. So automatically your URP is deducted here. That is, in subsidiaries P&L, it is deducted. Now what is left over is in holding company stock, you are supposed to deduct. So for this part, for holding company stock, when we are deducting, while we prepare balance sheet prepare inventories for balance sheet, when we add line by line, we will eliminate to the extent of profit and then show current assets. That is, your inventory will be shown at cost. Okay. So this is how we do. In case if it is upstream transaction, if it is downstream transaction, the profit will be in the balance sheet of holding company because holding company sold. Okay. So that is the reason why we stated that adjustment for URP will be done in step 4, because reserves of holding company is taken at step 4. Hence we are adjusting here. And secondly, with respect to subsidiary, the inventory contains that profit. We will eliminate that profit while preparing balance sheet directly. Okay. I believe your doubt got cleared. Yeah. So let's go to next point of discussion. Next point of discussion. Revaluation adjustments. Predominantly, revaluation adjustments will be done on the date of control. Okay. But if he gives you any revaluation adjustments after date of control, such profits will be going only to revenue side. Otherwise, revaluation profits will always be capital profits only. Okay. Why is this important? This is important because on the date of control, we are going to analyze the net worth of subsidiary based on date of control. If there is any revaluation profit prior to date of control, that is, on the date of control, I have increased the value. In such case, that revaluation profit will be taken on the C side. Otherwise, it goes on the R side. So that important aspect has to be considered. And whenever there is revaluation, mostly the questions will be along with revaluation, depreciation calculations also will be asked. Okay. In such case, you need to be cautious about depreciation. If at all, he specifically gives you information for depreciation also. Okay. So these are two important aspects to be careful about while you are preparing net worth analysis of subsidiary. Third adjustment, which is bonus adjustment. While testing for number of shares outstanding and number of shares held by holding company, you are supposed to ensure if there are any bonus issued in the previous financial year and whether it is properly accounted in both the books, that is holding company's books and subsidiary company's books, in their standalone financial statements, whether they are properly accounted for not is what you need to test for. Only if it is accounted for in both the books, you can consider bonus. Otherwise, what you should first do is, you should first do SFS adjustments, and then only get into consolidation. Okay. So this is third important aspect. Next, number 4, dividends. Dividends, you are supposed to check whether there is any pre-acquisition dividend which has gone into P&L of holding company. If it has gone, you will have to reverse that off and deduct from holding company's investment value, and arrive at a revised investment value. And then only then go ahead with consolidation. Till then you are not supposed to start consolidation at all. So whenever there are dividends, test for whether there is any pre-acquisition dividend, whether any information is given stating that there is pre-acquisition dividend which has been wrongly accounted into P&L and all. Accordingly, you should prepare your SFS adjustments and only then get into consolidation. Okay, so these are few important points which we should be cautious about. So with this intro, let us start with questions. Take out first question. Yeah. Let's first do with few basic problems, then get into other parts. Alpha Limited has decided to acquire all the shares of Beta Limited and has made a successful one-on-one offer to the equity shareholders of Beta Limited. The balance sheets of the companies are set out as below. Fixed assets, net current assets total, equity shares of 10 each, reserves and surplus total. Alpha Limited follows SLM method of depreciation, whereas Beta Limited follows WDV method. Had Beta Limited followed straight line method of depreciation, its accumulated depreciation would have been less by 250,000. Prepare CBS of Alpha Limited and its subsidiary Beta Limited using the information given above, assuming that offer has been I think there are two more scenarios here. Two more. Second scenario is offer has been 3 shares in Alpha for every 2 shares. Another question in their situation is next line. Assume that Alpha Limited has paid 2.5 per share for Beta over and above one-on-one share exchange. Now, first of all, there is one important aspect here. He is talking something about change of depreciation and all. If you observe a couple of years ago, when that amendment has come in the standard, change in method of depreciation is no more a change in accounting policy. Hence, there is no requirement of retrospective effect at all. A change in depreciation is a change in estimate now. Change in estimate. Hence, you need not bother about this at all now. Okay. So, any question of such kind, you can write a note stating that a change in method of depreciation is only a change in estimate, hence will not have impact. It is only to be considered prospectively but not retrospectively. So that's the adjustment, that's the note which you can write first and then start ahead with your answer. Okay. So let us do for this problem. Here he says, scenario 1, 1:1 is the exchange ratio is what he has given. So in such case, in the books of Alpha Limited, what he would have written as entry? In the books of Alpha, entry would have been investment in shares of Beta Limited account debit to equity share capital, because he is giving his own shares to some other person to buy over those shares. Okay, so he is buying in the open market. That means it would be 3,000 and 3,000 first entry. Okay, now will there be any entry in the books of Beta Limited? There won't be any entry in the books of Beta Limited because Alpha Limited is purchasing from open market. He is sourcing the shares from open market, that is secondary market, but not from Beta Limited. Okay, hence in Beta books, no entry for this. Okay, now let us start with consolidation workings. So 3 bullet points. Date of consolidation, he did not mention you much about all those. So he did not tell you about the dates and all, but he has directly given values. So let us directly start with 3 bullet points. Date of consolidation, date of control, you don't know. Shareholding pattern alone, he has mentioned that he has purchased 3,000 shares out of Beta's shares completely. That is, entire shares are purchased by him. So it is 100% subsidiary. Okay, shareholding pattern is 100:0. Okay, now with this info, let us start with first step. First step is net worth analysis of Beta. Net worth analysis of Beta. Take off 2 parts. C, R. You have share capital. Share capital given is 3,000 in the balance sheet. Reserves and surplus given are 1,600. I'm taking completely on C side because the same date he is consolidating is what I presume. Okay, so he is buying a company which is already existing. That means whatever profits are accumulated by that company in its P&L or reserves are completely pre-acquisition profits only. Hence, I will take complete 1,600 as pre-acquisition profits. Hence, it goes to capital profits C side. So the total comes to 4,600. This 4,600 completely belongs to Alpha only. There is no minority interest at all. Okay. Now, let us go to step 2. Step 2, minority interest. It is not applicable because it is 100% subsidiary. Step 3, cost of control. Let us see. Investment made by Alpha is 3,000. Share of capital profits from step 1 is 4,600. This 4,600. So you end up with a capital reserve of 1,600. That means you invested 3,000, got 4,600 worth of capital share of capital profits from the other company. Hence, there is an appreciation for you. Your capital reserve is 1,600. Okay. Step 4, reserves for CBS. Reserves for CBS. You have particulars. Holding reserves in holding company are there. So please see, there is only one word mentioned as reserves. That's all. So let us take it as it is. 1,800 is only the reserves. So there is no point doing separately this entire step. When we do other problems, we will do particulars. Reserves and surplus is only given. Holding company, it is 1,800. And capital reserve, I have 1,600, which I've got now. So total reserves for CBS would be 3,200, 3,400. Okay, 3,400 are my reserves, and the balance sheet comes out like this. I am doing it in T shape, but I would suggest you to do in vertical format only. Okay, so fixed assets. It is he has mentioned you something about depreciation, but as I mentioned, no need to make adjustment for depreciation. Hence, we will take it as it is. 4,800 plus 3,400 comes to 8,200. 8,200. Then current assets total is 3,200. And equity share capital, don't be in a hurry. Existing is equity share capital 5,000. Please see here. Existing is 5,000 existing here, but afresh I have given 3 more thousand shares to purchase these 3,000 shares from outsiders. That means my new equity share capital outstanding is 8,000 for alpha only. Only alpha's equity share capital this is. And then reserves for CBS from step 4. Reserves from CBS from step 4, it is 3,400. Total will get tallied. It is 11,400. 11,400. Any difficulty, please let me know. Basic problem, if you are able to follow, you can adopt to other problems easily. Any questions, please ask. Shares, sir. Okay. So please see, I have told you earlier that whenever we prepare consolidated balance sheet, equity share capital is only holding company's shares which we are supposed to take. Now in this problem, we have written an entry here. Please see. We have written an entry here stating that investment in shares of Beta Limited is 3,000 to equity share capital 3,000. This entry is not incorporated in the balance sheet which you have. This entry is not incorporated in the balance sheet which you have. Had this been part of your balance sheet would have been like this. I'll prepare and show. Please see. Had this been part of your balance sheet would have been like this. Equity share capital 8,000. Reserves and surplus, it is reserves and surplus, it is going to be 1,800. Is 1,800. And then you have fixed assets, you have current assets. So fixed assets and current assets were 4,800 and 2,000. Apart from that, you have investment in equity shares of Beta, another 3,000. This would have been the balance sheet. Sir, we are doing in the first scenario. Please see. A Limited has decided to acquire all the shares of Beta Limited and has made a successful one-on-one offer to equity shareholders. See, this is scenario 1. Okay. Second scenario is this. Third scenario is this. This is third scenario. So the same problem we are supposed to do 3 times. Okay. Now what we did is for first scenario. Okay. So in the first scenario, I would have got 8,000 shares in my balance sheet, and investment in equity shares of B Limited would have been 3,000. Reserves and surplus 1,800. Fixed assets 4,800. Current assets 2,000. So total would be 9,800. Okay. This would have been my initial balance sheet before consolidation. post consolidation, this is the balance sheet. Okay, so this is scenario 1. Let us go ahead to second scenario. Scenario 2, where the exchange ratio he has given is 3:2. So that means 3 shares for every 2 shares held. So in such case, entry in the books of alpha would be investment in shares of beta account debit to equity share capital. It is 3 for every 2. So for 3,000 shares, I will have to give 4,500. Okay. So this is second entry, second scenario entry, and your analysis of profits, analysis of net worth of subsidiary does not change from first scenario. Whatever you have done here, this continues to be the same. Net worth analysis of subsidiary, this does not change. The same 4,600 will come here also. Okay. So step 1, same as scenario 1. Step 1, same as scenario 1. Step 2 does not exist because you don't have minority interest at all. You don't have minority interest, not applicable. Next, step 3, cost of control. You have investment is 4,500. Share of capital profits is 4,600, in which case your capital reserve would be 100. Okay. Then the balance sheet would be like this. Please see your previous balance sheet. Equity share capital, earlier it was 8,000. Now it becomes 9,500. Equity share capital, now it becomes 9,500. How is it? It is 5,000 plus 4,500. Okay. Then reserves for CBS, I'm directly doing reserves for CBS would be holding companies reserves are 1,800, and now you have a capital profit of capital reserve of 100, both together 1,900. Okay. And then fixed assets does not change, same 8,200. Current assets does not change, same 3,200. So your total of your balance sheet continues to be 11,400. Okay. So this is the balance sheet in scenario 2. Scenario 2 balance sheet is this. Any doubts, please ask. If you guys are done, we will go to the third scenario now. The third scenario, he says, along with the 1:1 ratio, he is going to give in cash. In cash, 2.5 rupees per share. Okay. So in such case, entry would be consolidation investment entry. First entry would be investment in equity shares of beta account debit. Let's write it later. Then to equity share capital, it is going to be same 3,000. To bank 3 into so he has stated 2.5 rupees per share. Per share it is 2.5. So 300 shares into 2.5 comes to 750. comes to 750. So total my consideration is 3,750 is what I paid. So how did I get 300 shares? It is share rupees 10 each. So into 2.5. Into 2.5, I get 750. Okay. So this is first entry. After that, step 1, net worth analysis is same. Scenario 1, refer scenario 1. Step 2, minority interest, not applicable. Step 3, cost of control. Investment made is 3,750 and less share of capital profits received is 4,600. Hence, there is a capital reserve of 850. Capital reserve of 850. And again, I will directly jump into balance sheet and do any reserves adjustments. I'll do here itself. Now, in this case, equity share capital of holding company would be 8,000 only. 8,000 only. And reserves are capital reserve in the previous working you have got 850. I hope you guys are doing along. And reserves of holding company of Alpha is 1,800. Total is 2,850. Total is 2,850. And fixed assets does not change, 8,200. Current assets will change. Current assets will change because I paid 750 rupees in cash. 750 rupees in cash. Hence 3,200 minus 750. It is 2,650. Yeah, thank you. 2,650. Your total should be 10,850. Yeah, 10,850 or 650. Yeah, 850 I believe. 8,200 plus 2,650. It is. Oh, did I go wrong? Okay. 10,650. Then your current assets, I think it's wrong here. No, what is current assets value? Yeah, okay. So it is 2,450. Yeah, it matches 10,650. Thank you. So this is the problem. Okay. So basic, I thought maybe one simple problem to get in flow. I have given this, not that there's something which is asked or something like that. So to get that flow, I've made you do this problem. So we will take a break now and come back by 4:10. Okay. Thank you. Yes. Let's start. So let's go to second question, guys. Yeah, I'll read out the second question. Let others come, let them join. P Limited acquires 12,000 shares in F Limited for 1,70,000. The balance sheet of the two companies on 31st December 2014 were as follows. Equity shares of 10 each, reserves and surplus, general reserve P&L, loan from related parties, loan from F Limited including interest, bills payables, trade payables total. Then assets, tangible assets, land and building, plant and machinery, goodwill, current assets, inventories, non-current investments are there, 1,70,000. Current assets, inventories, trade receivables, bills receivables, cash and cash equivalents, short-term borrowings, loans and advances to related parties, 50,000 total. On 1st January 2014, the general reserve and P&L account of F Limited stood at 1,50,000 and 40,000, out of which a dividend of 15% on the then capital of 2 lakhs was paid in June 2014 for the calendar year 2013. At the same time, a bonus issue of 1 share fully paid for every 2 shares held was also made out of general reserve. Bills payable of F Limited represent bills issued in favor of P Limited, of which the company still held 40,000 of the bills accepted by F Limited. The entire closing stock of F Limited represents goods supplied by P Limited at cost plus 20%. P Limited and F Limited agreed that for services rendered, P Limited should charge 500 per month from F Limited. Entries for this were not made when the accounts were drawn up. The service contracts between were entered into immediately after P acquired shares in F. The loan of P Limited was made by F on Jan 1st, 2014. Prepares consolidated balance sheets of the two companies as on December 31st, 2014. So question is a very holistic question which has got many adjustments in it. Let us see each of them, and first let us discuss what has to be done. Then we will get into the problem on how we should do it. Okay. So first and foremost important thing, if you observe the balance sheet properly, you have two catches here. The first catch is loan from related parties. In liabilities, it is shown as 57,500, whereas under assets, it is shown as 50,000. That means interest accounting did not happen in one of the books. Okay. Next. He says general reserve so and so and all opening balances were given on 1/4/2014. Why are they given? To make you consider them as pre-acquisition profits there. Okay. So for calculation of pre-acquisition profits, that is capital profits and revenue profits, you need that differentiation. Next, there is a bonus issue which is made out of general reserve is what he says. Now, please see whether the shares are share capital given after bonus issue or before bonus issue. Okay. So P Limited says he has acquired 12,000 shares in F Limited for 1,70,000, and the balance sheets are given after that. So the 3 lakh shares are believed to be after bonus only. Okay. So he has given 1 share for every 2 shares held. Bonus accounting in the books of subsidiaries properly done. From where do I get that information? He has given indirectly, stating that in the first para, if you see, a dividend of 15% on the then capital 2 lakhs was paid in June 2014. That means earlier my share capital was 2 lakhs. When the share capital was 2 lakhs, I invested in 12,000 shares. I invested in 12,000 shares, and in the balance sheet today it shows 3 lakhs as share capital. That means post bonus issue 2 lakhs has become 3 lakhs as share capital. Okay, so this is next important point. Like the same way, bills payable, please see. He says they represent bills accepted by 40,000 to the extent of 40,000. So let us do adjustments. Intercompany adjustments have to be done for that. Next, entire closing stock of F Limited represents goods supplied by P Limited at cost plus 20%. Now, who supplied to whom? It is P who supplied to F. That means that is a downward URP downward transaction. Here it is URP downstream. Okay, there is URP downstream. So adjustment should be done at step 4. That is when we adjust for reserves for CBS of holding company. Okay, next, P Limited and F Limited agreed that for services rendered, P Limited should charge 500 per month from F Limited. Entries for this were not made when the accounts were drawn up. That means accounts were not completely done. So we will have to first prepare adjustments for SFS adjustments. Only then we can go ahead for consolidation. So with this intro, let us start with standalone financials adjustments, then go get into consolidation. So first of all, let us do SFS adjustments in the books of holding company. Then we will see if there is any adjustment to be done in subsidiary company. Okay. So part 1, SFS adjustments in P Limited. SFS adjustments in P Limited. Sorry guys. Now, so first adjustment to be made is there is some dividend about which he has stated. Please see. On January 1st, 2014, please see this paragraph, out of which a dividend of so and so is paid. Now, how do I understand that there is a mistake in this? Read your investment. Read through your investment. He says non-current investments in the balance sheet are 1,70,000. In the top, he says he has purchased 12,000 shares for same 1,70,000. So no. So that means he has not made adjustment for investment accounts for your pre-acquisition dividend at all. I purchased the shares on 1/4/14. I have purchased shares, and the dividend which is given is for 2013. For the calendar year 2013, it is given in June 2014. That means the dividend what I earned has got some pre-acquisition dividend, which is supposed to be adjusted against my investment, but should not go to P&L. So let us write entry for that. Entry would be, so first of all, it is towards pre-acquisition dividend. Towards pre-acquisition dividend, this entry is being written. Entry would be, you are supposed to reverse it from P&L account debit to investment in F Limited. This should be reduced. Now, what is the amount of dividend I have received? I have received on 2 lakhs is the total amount of equity share capital of F Limited. Out of that, I hold 12,000 shares, that is 60%, into he has given 15% dividend. Okay, so 15%. Can you please tell me the number? Someone? 18,000. Okay, so this dividend is 18,000. Hence, 18,000 should be reversed. Okay, so this is the first entry. Okay, next. Second, there is a bonus issued by subsidiary to all shareholders. So though there will not be any entry for bonus, just mention number of shares after bonus is equal to 12,000 plus 6,000, that is 1 for every 2 held. Hence it is going to be 18,000 shares. Okay, next, number 3. He says for every month of service rendered, he has to get 500 rupees. Yes or no? For services rendered, income is not accounted. He says income is not accounted at all. So entry for services rendered. Entry for services rendered would be F Limited account debit. It is, he says it is from a month in between the financial year. That is from April onwards, from when they both have come together. Yeah, it's for 9 months. Thank you. So 9 into 500, 4,500 rupees would be my income, and it goes to P&L account. 4,500. Okay. So broadly, these are my net adjustments. Now, same way, write adjustments in F Limited also, if there are any SFS adjustments. So part 2, SFS adjustments in F Limited. SFS adjustments in F Limited. First important thing which I told you is that loan interest. From the balance sheet, it is clearly evident that one party has not accounted for interest at all. Okay, so interest on loan has to be accounted for. So loan to P account debit to P&L. It is 7,500, 7,500. How did I get that 7,500? It is difference between 57,500 and 50,000. That means P Limited has accounted interest, but F Limited did not account interest. Hence, I am accounting here. Okay. Next. For services rendered again. For services rendered, entry would be P&L account debit to P Limited. To P Limited, it is 4,500 and 4,500. Fairly speaking, P Limited will anyways get knocked off. But why are we writing this entry? Because into your P&L you should bring that 4,500 impact. Okay, so that's the reason why we are writing these entries. Now that we are done with all SFS adjustments, let us go ahead with consolidation. Let us go ahead with consolidation. Now let us see the question once again. What all information are important? So my date of consolidation is 31st December 2014. Date of control is 1st April 2014, and shareholding pattern is 60/40. Okay, so let us write that first. Part 3, consolidation. So in that 3 bullet points: date of consolidation, date of control, shareholding pattern. It is 31/12/14. I purchased on 1/4/14, and shareholding pattern is 60/40. Okay. Now, step 1 is net worth analysis. Net worth analysis. Split it into 2: capital and revenue, which is C and R. So you have share capital. Always share capital goes on C side. I have 3 lakhs of share capital, that is subsidiaries. Take complete 3 lakhs. Next, general reserve is there, P&L is there. Let us not directly take numbers. Let us do some working notes, because he has told you that there are some adjustments which are made. Okay. So what I'll do is working note 1. So in your page, what you can do is you leave some 10 line space after this, and then do working note number 1. 10 line space, and then do working note number 1. General reserve analysis. General reserve analysis. 1 second, guys. Sorry. Yeah. So general reserve opening balance is 1,50,000 is what's given there. And he has also stated that there is bonus which is given out of this opening balance. So 1 lakh is the bonus which is utilized, and net off is what your closing balance available is 50,000. So which means out of this belongs to C, because there is a capital profit. This was there even before my investment in this company. Out of this, he has consumed 1 lakh towards bonus issue. So that means net off is actually capital profits only. So entire 50,000, whatever is there in the balance sheet, is basically capital profit for us. Okay. So that is the analysis what we have done. Did you guys understand? I have taken opening balance and then reconciled it to reach closing balance. Reconciled it to reach closing balance, and each of those items I have marked them whether it is capital profit or revenue profit. Okay, so this is what I have done. Please see, 1,50,000 is opening balance. 1,50,000 is opening balance, and out of that, the company has paid out bonus out of it for 1 lakh. Hence, that is taken, and closing balance anyways comes to 50,000 only. That means there are no current year transfers from P&L to general reserve at all. That is what you need to understand. Okay. Now, since we are here, let me tell you, whenever you have general reserve and P&L like that, many reserves, always first do other reserves and only then at the end do P&L. And only then at the end do P&L, because most of the problems, what happens is there will be transfers from P&L to general reserve, P&L to some other reserve, like that there can be some adjustments. So first what you're supposed to do is first do all other reserves. Then at the end come to general reserve for analysis. Okay. So working note number 1 is over with respect to general reserve. Now working note 2 for P&L. For P&L, let us do it now. Now, opening balance, what is given on 1114 is 40,000. Okay. And out of this, he has mentioned that in the para below, he has given a dividend for 2013. Dividend is given out of this for 2013. 15% dividend is paid out of this, which is 30,000. Okay. And apart from this, I have not accounted for the two adjustments, SFS adjustments, which we have written here. Please see, I have not accounted for 7,500 of income and 4,500 of expense. Those two I'll have to bring in here. Okay. So interest on loan. Okay. Interest on loan is 7,500. 7,500 and service cost is given as 4,500. 4,500, and I have a closing balance of in the balance sheet. If you see the balance sheet, it is mentioned as 85,000. Please see here, it is mentioned as 85,000, but this 85,000 is before considering the SFS adjustments which we did now. Okay, so we'll have to take the revised balance because we are taking here these numbers. Okay, so what I'll do is I need one more line here. I'll tell you why. So closing balance given is 85,000 only, but plus 7,500 minus 4,500, it becomes 88,000. 88,000. Okay. Now this 4,500 is a service cost. Now whatever balancing figure I get here, is nothing but current year earnings for me. Current year earnings. Current year earnings. Can you please tell me someone? Balancing figure. It comes to 70. Yeah, thank you. 75,000. 75,000 is balancing figure. How did I arrive at this? I have taken opening balance. I have taken all the transactions which I know, and the balancing figure would be current year earnings only. Okay. So with this info, let us see how much goes to C side and how much goes to R side. Now, this 40,000 is completely on 1/1/2014. So these are capital profits only. And this dividend paid for 2013 is also out of capital profits only. Interest on loan is actually earned for 12 months. Is actually earned for 12 months. That means I should split it into two. I should split it into two. That is capital and revenue. So for capital, it is going to be 3 months. So 3 months out of 7,500. Please tell me 7,500 into 3 divided by 12. It should be 1,800. 1,875. Okay, fine. Yeah, thank you. 1,875. This belongs to C, and R is, I'll explain. R comes to balancing figure, which is 5,625. See, this 7,500 is interest on loan. Please see the question carefully. Please see the question carefully. I will take a pencil and do. So please see here. I guess this visible. Please see here. 57,500 is the amount of loans and advances, and at the same time, in asset side of subsidiary, it is mentioned as 50,000 only. That is 7,500 of income for subsidiary. Now he has told you at the end, stating that the loan to P Limited was made by F on 1st January 2014. Right now we are on 31st December 2014. Hence it is for 12 months interest. 12 months interest is 7,500. But I purchased these shares in this company only on 1st of April. Hence, any profits which are made prior to that should be called as capital profits. Any profits made after my investment should be called as revenue profits. Hence, considering that your profits, what you have interest on loan, which is interest earned. This amount of 7,500 is 1,875 is only earned prior to my investment in subsidiary, and 5,625 is earned after my investment in subsidiary. So I should split this into 1,875 and 5,625. That is C and R. Okay. Next, service cost. If you see, service cost is something incurred only after my control. So it is going to be completely R. And 75,000. Since he has not mentioned about the trend in which profits are earned, I would believe that this entire 75,000 is earned evenly throughout the year. That is actually the heading of the question. Okay. Heading of the question itself is, I will tell you, Venkatesh. 75,000 is earned evenly throughout the year. That means this also should be split into two, C and R, because this profit is earned over 12 months. Out of this 12 months, 3 months only is C and 9 months is R. So in this case, it is going to be 18,750 and 56,250. Now, your question regarding closing balance, it is 85,000 in the question. I don't deny that. But there are two SFS adjustments which you have passed now. Please see this screen. You have passed two SFS adjustments. One, income for 7,500. Second, expense of 4,500. These two were not accounted at all in your books. Now, after accounting these two, after adjusting for these two, it will be 88,000. Please see, 85,000 plus 7,500 minus 4,500. Minus 4,500, it gives you 88,000 only. I hope I made it clear. Okay. Now, so now what you're supposed to do is, you're supposed to take each of these C's. If it is positive, add. If it is negative, deduct. If it is positive, add. Negative, deduct. Each of these C's, please take, and total of C has come to 30,625, it seems. Okay. This 30,625 will be taken on C side. And same way, total of R, I am coloring it in, I think, sorry, by mistake, I have rounded this off. Okay. Now, all R's, please round off. 1, 2, 3. Okay. So 57,375 is R, it seems. I hope you guys are able to follow. Net worth analysis is the only place where you need to be cautious. Once this is done, your problem will be very smooth. Okay. So it is going to be 57,375. Okay. Now, total of all this, please tell me. It is going to be 3,80,625 and 57,375. Now, why didn't we take URP here? It is because holding company made that unrealized profit, not subsidiary. We are only analyzing net worth of subsidiary, hence we did not take up that unrealized profit part here. Okay. Now, from this, you can split it between holding and minority interest. It is 60 and 40. 60 and 40. Okay. So 60% of 380,625 would be 228,375. And for minority interest, it is 152,250. For revenue profits, share is 34,425. This is completely P&L only. This is completely P&L only. And 22,950. This is completely P&L. I have a reason, because we are supposed to mention in reserves for CBS part what this is. Okay, this is P&L. Okay. So with this, we are done with net worth analysis of subsidiary. Okay. What is critical out of this entire thing is analyzing your P&L reserves only. Okay. So once we are done with this, we can go ahead with step 2, that is minority interest. While calculating minority interest, you are supposed to take two numbers, that is capital profits and revenue profits. So it is already done here. So both these numbers, if we take, it is sufficient. Both these numbers are sufficient. So it is capital profits 152,250 and 22,950. Total comes to 1,75,200. Thank you. 1,75,200. Now next, step 3. Step 3, cost of control. Cost of control. Be little cautious. Be little cautious. Investments given is $1,70,000. Given is $1,70,000. However, please see in the beginning, in part 1, we have written this entry for 18,000. This is basically to be adjusted against your investment. Hence, let us write that adjustment here. Investment given is 1,70,000 less pre-acquisition dividend 18,000. That means My revised investment is 52,000. 52,000. Okay. So out of this, now I'll have to reduce my share of capital profits. Share of capital profits. My share of capital profits are this. 2,28,375. 2,28,375 is my share of capital profits. When I deduct this, I get a capital reserve. Thank you. It is 76,375 capital reserve. I believe you guys are able to follow everybody. Thanks for the answer. So capital reserve at 76,375. Now, having done this, let's move to next step. Reserves for CBS. Step 4, reserves for CBS. Reserves for CBS, as I told you, it is going to be particulars and number of columns based on what all you have. Particulars, you have general reserve, you have P&L, you have capital reserve. Okay. So let us take all the 3 columns at a time and do. Now, P Limited's own reserves revised. Own reserves revised should be taken. If you observe, P Limited's general reserve from the balance sheet is 42,000. 42,000. However, P&L would not be the same because there are some adjustments which we did to it. There are some adjustments which we did to it. Oh, it is 4,20,000. Sorry, I'll change it. I'll change it. It's 4,20,000. Now, P&L, if you observe, it is given as 2,60,000. However, I have made few adjustments in my SFS adjustments. I have made few adjustments in my SFS adjustments. So these are my adjustments which I did. 18,000 I have reduced, and I have increased 4,500. I have reduced 18,000 and I have increased 4,500. So the total comes to 2,29,500, I guess. Please see and tell me, guys. Please tell me P&L balance. 2,60,000 minus 18,000 plus 4,500. Yeah. So it is going to be 2,46,500, which is my P&L revised balance. Revised balance. Now from this, let us do that URP adjustment. URP adjustment. URP adjustment. Let us do. He says whatever is in subsidiaries books, that is supplied by me only. That is holding company supply only. So in such case, I will have to calculate what is the amount of profit on that goods. Now in subsidiary, inventory's value is 40,000. So, and he says the profit made is cost plus 20%. Cost plus 20%, and 40,000 is your selling price. So you are supposed to identify 20% of selling price. Okay. So it's going to be 40,000 into 20 by 120. URP adjustment is 40,000 into 20 divided by 120. You get 6,667. This should be deducted. Okay. Apart from this, you have share of subsidiaries profits, which is only from P&L, which you can take directly, which is only from P&L. It is 34,425. And apart from that, you have capital profit from step 3, which is 76,375. Okay. Now, total all this, net off and tell me what are the values. So total here it is 4,20,000. Here it is going to be 2,74,258. This is 76,375. Tell me grand total, please. Please tell me grand total. With this, we are almost done. We can prepare balance sheet now. Okay. Thank you. 7,70,633 is the value of your grand total. Now let us go ahead with the balance sheet. I will directly do any adjustments here itself. If you feel you would like to, adopt working notes for balance sheet items, that's fine. That's fine. So I'll start with share capital. Share capital, always only holding company, which is 10 lakhs given. Which is 10 lakhs given. Then reserves for CBS. P&L once in step 4. Yeah, please see. 2,46,500 is revised the P&L balance from holding company. Then you have deducted unrealized profit of holding company in sale of goods to subsidiary, which is existing right now in the balance sheet. Okay. So 6,667 is this 34,425 is from your step 1. See, please see here, this number it is. 34,425 is share of revenue profits from subsidiary. Holding company's share of revenue profits from subsidiary is 34,425. That is from P&L only. Why would you deduct? You are supposed to add. No, that's a profit. That's a profit we have got. We are supposed to add. It would not get deducted. See, only in cost of control calculation, you would deduct the amount of capital profits. See here. Okay. But in revenue profits, it's going to be addition only. If it is positive, you add. If it is negative, you deduct. Okay. So let's go to the end. Reserves for CBS, it is mentioned as 7,70,633. Then non-controlling, sorry, minority interest. I mean Ind AS swing. So it is 1,75,200. Then intercompany owings, if there are loans, the loans are now fully accounted. Now we can completely ignore them because both get knocked off. 57,500, 57,500, both get knocked off. You need not write those at all. Then you have trade payables. You have trade payables. You have trade payables of let me see. Yeah, trade payables. Both together, it is 1,82,500 plus 42,000. 2,24,500. So it's going to be same 2,22,500 because to this we are supposed to add 4,500 and deduct 4,500 because 4,500 was not included in this at all. Okay. So it's going to be like this. It's going to be 1,82,500 plus 42,000 plus 4,500 because it was not earlier accounted. Now you should deduct because it is intercompany owing. So effectively, it's going to be the same 2,24,500. 2,24,500. Okay. Then bills payable, he says there is 40,000 which is intercompany owing. So both together it is 1,40,000 minus 40,000, it becomes 1 lakh. Minus 40,000, it becomes 1 lakh. I believe liability side, that's it. And asset side, let us come down. Asset side, fixed assets, all put together, it is 14,70,000. Then investments will not come. And then you have inventory. Inventory, you have an adjustment to make, which is that 6,667 to be deducted. So it becomes 2,33,333. Then trade receivables, same, just like that 4,500. It's going to be the same number. Same number. It's going to be 3,85,000. Bills receivable. Out of 80,000, it is 40,000 gone. So 40,000 is left over. Cash and cash equivalents, directly both together you can take, which is 1,42,000. And loans get knocked off. Loans, nothing. Here also loans, nothing. So I believe your balance sheet should get tallied here. Please check. Tell me the balance sheet total. Tallied 22,70,333. Okay. I believe you guys are able to follow. Any questions, please ask. Any questions, please let me know. Otherwise, we'll go ahead. All right. Let's go to next question. FA details are. All these together here. FA details are all these together. Okay. So let us go ahead. Please see third question. Balance sheets of Ashish and Anand as on 31st March 2015 are as follows. Equity shares of 10 each fully paid. General reserve P&L. Current liabilities, trade payables total. Assets, buildings, plant and machinery, furniture and fittings. Non-current investments 2 lakhs. Current assets, inventories, trade receivables, cash and cash equivalents total. Prepare CBS after considering the following. Ashish Limited acquired 8,000 equity shares of Anand Limited on 1st July 2014 at 2 lakhs. Stock of Ashish Limited includes 6,000 relating to stock at cost purchased from Anand, which sells goods at cost plus 25%. Sundry creditors of Ashish Limited include 10,000 due to Anand Limited. Profit and loss account of Ashish Limited includes interim dividend received from Anand. Interim dividend was at 10%, which was declared by Anand Limited after 1st July 2014. Balance profit and loss account as at 1st April 2014 is in Anand's ledger stood at 56,000. Profit during the year 14-15 have been earned by Anand Limited on uniform basis throughout the year. So this is a case where you have some interim dividend received from this company, and how should I deal with such interim dividend? Now you need to observe the date on which these guys have invested in the other company. If you observe carefully, he says he has acquired 8,000 shares on 1st July 2014. Now investment made is 2 lakhs and the investment being shown in the books is also 2 lakhs. That means he did not account for your dividend adjustment at all. That is pre-acquisition dividend, whatever adjustment is to be done, it is not at all adjusted. Hence we are supposed to first do that and then go ahead with other steps. Okay. So problem wise, it's not too difficult. Simple only for that dividend adjustment we are supposed to learn this. Okay. So let us go ahead. Like how I said, whenever there are entries which are missing, we will first pass SFS adjustments and only then go to other adjustments. Okay. So part 1, SFS adjustments. SFS adjustments in Ashish. In Ashish Limited. So first adjustment is dividend adjustment. He says there is dividend which is given, but he has completely taken it to P&L. Why shouldn't it be taken to P&L? Because only for 9 months he earned. That is, any additional amount of dividend which is paid to him should go towards adjustment of your capital. Okay. So entry for the dividend adjustment would be P&L account debit to investment in shares of Anand. Value is, he has got 1 lakh share capital into 80% I hold into 10% is the dividend given into 3 months out of 12 months, because the balance 9 months I hold those shares. I invested money. Hence, that is allowed to be in P&L account. Only for the first 3 months it's not allowed. Hence, I am removing it out of it. So value comes to 2,000. Thank you. Value comes to 2,000. That's it. Okay. So this is the only adjustment which is supposed to be done. We did it. So let us start with consolidation, part 2, consolidation. Okay. In consolidation, you have 3 bullet points: date of consolidation, date of control, shareholding pattern. Shareholding pattern is 80-20. Date of control is 1-4. and your sorry 17 and date of consolidation is 31/3. Okay, so these are your 3 bullet points. Then we can start with consolidation. Step 1, net worth analysis of Anand Limited. Net worth analysis of Anand split into 2 parts: C, R, capital and revenue. So you have share capital. Share capital given is 1 lakh. General reserve, he did not tell you any adjustments at all. Okay, when no adjustments are mentioned, what I would presume is it is completely pre only. Otherwise, he would have told us that every year general reserve transfer is so much, or else in this year general reserve transfer was so much, or else at least he would have told you what is opening balance of general reserve so that you can presume something out of it. In this problem, nothing is given. Hence, you can directly take 4,000 as capital. Then P&L we will have to work out. So it is working note 1. Let us do working note 1, P&L analysis. P&L analysis. So opening balance, he has told you that on 1/4/14 it is 56,000, which is C. Okay, and then he has paid interim dividend. Normally the presumption is interim dividend is paid out of this year's profit only, not out of opening balance. Okay, hence we will first take current year additions, then deduct interim dividend. Interim dividend is 10,000, which is paid. Okay, this 10,000 should be split into C and R because I purchased shares in between the period. So it's going to be 2,500 and 7,500. Both are negative only. Okay, and closing balance given is 72,000. Okay, 72,000 is closing balance. Now that means the balancing figure which I get here is current year earnings, which comes to 26,000. This 26,000 also should be split between C and R because he says it is earned evenly throughout the period. Hence, C would be 6,500 for 3 months. R would be 19,500. Okay. So with this info, total of all C's, please take it to P&L. Please take it to C side. Total of all C's, I'll color it in pink. This is C, this is C, this is also C. And total of all R's, I will color it in green. Take them to R side. 1, 2. Okay. So totals, please take. Please tell me the numbers. Okay, thank you. 60,000 and 12,000. Next, there is in this problem URP upstream. There is URP upstream. Okay. Now, what is URP upstream? He says 6,000 is for his cost. There is English here. You need to be thorough with English in such cases. He says stock of Ashish includes 6,000 relating to stock at cost. Whose cost? Ash is cost. Okay, Ash is cost. That means that is sale price. For Ashish, if it is cost, it is nothing but sale price. Purchased from Anand, which sells goods at cost plus 25%. Okay, that means if 100 rupees is my cost, I sell it at 125. Okay, I will have to identify what the 25 is. Okay, so now let us go back there and do it. URP upstream, it is 6,000 into 25 divided by 125. So I get a value of 1200, which should be deducted. Okay, now, so with this, all items in your net worth analysis are over. Now let us close this. Total of C and R, please. R is 10,800 and C is 1,64,000. This 1,64,000 should be split between holding and minority interest in the ratio of 80:20. Same way here also. Okay. So values are 1,31,200. Thank you. And 32,800. And this 8,640, 2,160. Thank you. Okay. So this is your first step. Once this step is over, everything goes seamlessly. So next, second step would be your minority interest. Minority interest is fairly simple. Nothing but 2 bullet points from your same working, which is these two numbers is minority interest. So 32,800 and 2,160 should be taken. 32,800, 2,160. Total it is 34,960. 34,960 is minority interest. Next, step 3. Cost of control. Cost of control. Investments. Investment given is 2 lakhs. Given is 2 lakhs. However, there is a SFS adjustment. SFS adjustment which you have written there stating 2,000 rupees is your adjustment against investment. So my revised investment is 1,98,000. Revised investment is 1,98,000. From that, less share of capital profits. Share of capital profits is 1,31,200. That means I end up with a goodwill of 66,800. Thank you. 66,800 is goodwill. Why it is goodwill? When I am receiving only 1,31,200 worth of net assets or net worth, I have paid 1,98,000. Okay, hence it is goodwill here. So once this is done, I can go ahead with reserves for CBS. Reserves for CBS. Step 4. So in this problem, I only have 2 reserves because there is no capital reserve. It's only 2 reserves. It is particulars and 2 amount columns, general reserve, P&L. Okay. So holding companies own reserves are there. Holding companies own reserves are 2,80,000 and revised P&L would be 1,68,000. Why is it revised? Because the 2,000 got reduced. The 2,000 got reduced. And subsidiary, from subsidiary, share of subsidiary reserves is from your step 1. This circle which is not circled at all. This 8,640. It goes to 8,640 here. Okay. Total these two It is 2,80,000, 1,76,640. Total would be 4,56,640. Okay. If you are done with this, we can go ahead with balance sheet. Are you guys able to follow? Any doubts, please ask me. Any doubts, please ask me. 1,68,000, sir. Wait, I'll show you. In the balance sheet, he says the profits P&L account of holding company is 1,70,000. Out of that, in SFS adjustment one, first part, we stated that there is 2,000 of interim dividend, which is pre-acquisition dividend, wrongly taken into P&L. We have corrected it there. We have written an adjustment there. So on adjusting that, what you get is 1,68,000. Okay. So with this, we are done. Lastly, let's go ahead with balance sheet. Let's go ahead with balance sheet, CBS. Equity share capital, it is 4 lakhs. Then reserves for CBS. Reserves for CBS is 456,640. Then minority interest is 34,960. Okay. Then your trade payables, he has mentioned that there is 10,000 of dues. Okay. Trade payables would be 95,000. Fixed assets, it is 6,12,000. Goodwill you have now, which you got 66,800. Then investments will not come. Inventories you are supposed to take. Both the companies together minus 1,200 should be taken. Both the companies together minus 1,200 would be 1,17,000 minus 1,200, 1,15,800. Then trade receivables again less 10,000. So it's going to be 1,02,000. Cash and cash equivalents, it is 90,000, both companies together. The balance sheet should get tallied. Balance sheet totals, please. Okay, thank you. 9,86,660. 9,86,660. I hope you guys are able to follow. Yeah, thank you. Any doubts, please ask. Yeah, sure. Now, in the question, he has mentioned about URP transaction where he says stock of Ashish Limited includes 6,000 relating to stock at cost plus cost purchased from Anand, which he sells goods at cost plus 25%. Now, what he is saying is you need to understand that English separation. That's all in this. Ashish has purchased for 6,000 rupees. That means for him it is selling price. For him it is selling price. He purchased for 6,000, which normally Anand sells at 125% of cost. That is 100 plus 25% of cost. So out of the 6,000, I am supposed to eliminate the amount of profit. So I'll have to remove the profit alone in my P&L account. So for that, what we have done is, we have taken it like this here. 6,000 into 25 divided by 125. 125 is my MRP. Out of the 25 is my profit. So that 25 I have identified and deducted from my P&L account. Okay. So this is what we have done here. Any other questions? All right. Let's go ahead, guys. Next question. Yeah. Sale and successive purchases. Let me first explain about it. At times what happens is the holding company H Limited may invest in subsidiary in various tranches. That means H Limited initially has invested 30%. Can I state that there is control? No control. Next, again another 20% is invested. Can I state that there is control? I cannot state that there is control. Same way, again, after this, cumulatively, I have another 20% I have purchased. So cumulatively, my percentage has become 70. Hereafter, I have control. Okay. So this is what we call as successive purchases. Successive purchases. And what does successive sale mean? Successive sale means after this purchase, at times I may sell off 10%, but still I hold control because I hold 60%. Okay. Again, another 5% I have sold, but still I have control because I hold 55%. So these are what we call as successive purchase and sales. In case there are any successive purchase and sales, how do we deal is what the question is about. Okay. Now, whenever there is sale of investment, that is first part in this is there are two things in it. One is sale of investment. Second is purchase of investment. First, let us talk about sale. Then we will talk about purchases. whenever there is sale of investment, what standard says is we are supposed to adopt a net off treatment. Net off treatment, and give that effect to cost of control. What does this net off treatment mean? This means, for example, on 1/4/14, I purchased 80% in a company. On 1/4/16, I sold 20% in the same company. Now, even after sale, I still hold 60%. That means I still control the entity. Hence, consolidation is applicable. What standard says is you adopt 60% as your shareholding pattern and consolidate as on the beginning date. That is what we call as net off approach. Net off approach. Okay. So this is first part with respect to how you deal when you have a sale in the existing number of shares. Now let us come to second part, when we have purchase of shares. When we have purchase of shares, whenever we purchase, the number of shares what we control or the number of shares what we hold will increase. Yes or no? That means I will have to prepare my net worth analysis using incremental charts. Incremental charts are to be prepared. What are incremental charts? Incremental charts are nothing but for the first date of control. For example, same example let us take on CR. My first date of control happens to be 1/4/14. Okay. My next date of purchase happens to be 1/4/15. I have purchased 10%. Say, you are supposed to prepare an incremental chart along with the first chart. Why is this required? Because I will have to analyze my profits into C and R based on the next purchase date again. Hence, what we will do is we will incrementally prepare what is the impact here. We will prepare the C and R based on the new date and take profits on C side and R side independently. C side and R side independently, and at the end, after you total all these, this would be split between C and R, holding and minority interest in the ratio of original sharing ratio, that is your 60/40. This also would be distributed between holding and subsidiary, holding and minority interest in the ratio of 60/40. Here profits, whatever you get out of this, when you purchase, that means your minority interest shareholders value has fallen down. Yes or no? Say you purchased a 10% stake. In such case, H Limited will get 10% out of it and minority interest will lose 10% out of it. And in the same way, revenue profits also, H Limited will gain 10% out of it and minority interest will lose 10% out of it. Okay. So this is what's supposed to be done if it is purchases after the initial control. Okay. I'll repeat this once again for your interest. There are two types of adjustments which can happen. One, successive sale. Second is successive purchase. If it is successive sale, take the net off treatment. What does net off treatment mean? After the sale, what is the percentage I have? That percentage will be considered with effect from first control date. With effect from first control date. That is for successive sale. But when it comes to successive purchases, you will have to adopt a bifurcative treatment like this. That means share capital I have, share capital should be taken on C side. Same share capital will be taken on C side for second incremental table also. and revenue profits or general reserve P&L, whatever you have, you will analyze based on this date, yes or no? You will analyze based on this date and take it into C&R. Same way, you are supposed to analyze profits into C&R based on the second date again. Based on the second date again. Okay. And then you take all the profits and losses in their respective places. After which, in the final totals, what you are supposed to do is first table's profits, first table's capital, C side total and R side total will be split between holding and minority interest, both the capital and revenues. And when it comes to incremental profits, incremental, you will have only incremental amounts will be transferred from minority interest to holding company. Okay. So this is what you're supposed to do. If you have not understood, don't worry. When we do the problem, you will understand it better now. So with this intro, let us go ahead with fourth question. Please see. H Limited purchased on 1/4/2012 8,000 shares of 100 each in S Limited when S Limited had 10 lakh share capital. It sold 500 such shares on 1/4/2013 and purchased 1,000 shares on 1/4/2014. S Limited paid 15% dividend each year in September and there was no change in share capital account up to 31st March 2015. Profit and loss account balances in S Limited and investment of H Limited in S Limited on different dates were as under. Yeah. Okay. So date of purchase, P&L balance of S Limited, investment of H in S Limited as per the account in ledger in books of H Limited. So he has given you various data. Thus, the amounts shown as investments in column 3 above represent cost price as reduced by sales and increased by further purchase without any adjustment for profit or loss on sale or for dividend. He has specifically told how he is maintaining that account, how he has given that, he has arrived at the numbers. He says it is cost price as reduced by sales and increased by further purchases without any adjustment for profit or losses or dividend. That means in this account he has not accounted for pre-acquisition dividends, he has not accounted for profit or loss. Whatever is there is purely your transaction detail, that's all. Transaction price at which you have purchased or sold, that's all. Okay. So considering that, we are supposed to prepare consolidated financials is what he is asking us. Okay. With this info, let us start. Now, whenever a problem of this kind is given, you are supposed to prepare a revised investment account for your convenience, because you need actual costs incurred. Actual cost on purchases is required. Hence, we will have to prepare investment account for shares purchased and sold. Okay. So let us do that now. So let us open an investment account. Investment account. Ensure 2 columns on each side. One is for numbers, second is for values. Okay. Now he says his first transaction was on 1/4/2012. He purchased number of shares and amount. Again, number of shares, amount. He purchased 8,000 shares. He has purchased. Initially, he says he has invested 12,80,000. Okay. And after that, what happened? The subsidiary has actually issued dividend. It has paid dividend on every 30th of September. It is paying dividend. So on 30th September 2012, I would have received dividend. Which is a pre-acquisition dividend, because for last year I'm receiving. Hence, I'm supposed to reduce it from this investment account itself. So amount of dividend would be 10 lakhs into 80% is my shares now. 80% into 15%, which is dividend. 15% dividend. So dividend is 1,20,000 for me. Okay. Now on 31st of March 2013, you have 8,000 shares whose value is 11,60,000. Now hereafter, if someone asks you what is the cost at which you bought, it is only 11,60,000. You cannot tell that it is 12,80,000. Okay. Now, so this is your first year. Next, on 1st of April 2013, you have an opening balance of 8,000 shares and 11,60,000. Okay. Now, out of these shares, he says he has sold 500 shares. 500 shares he has sold, and let us take only costs here. Whatever price he has sold, let us take about it later. Okay. So on 1/4/15, sale happened for 500 shares. How did he sell those 500 shares? You are supposed to take cost. It is 11,60,000 divided by 8,000 shares into 500 shares, which comes to 72,500. Clear? So what is closing balance of number of shares I have now? Cost of number of shares. So cost is basically, I have 8,000 shares, 11,60,000 here, 8,000, 11,60,000 here. I have right now 7,500 shares. Value is 10,82,500. 87,500. Sorry, 10,87,500. Okay. So this is my value as on 31st March 2014. Okay. Next, same way on 1/4/14, let us go. Dividend. Very good question, sir. We are in the second year. By that year, I have already earned dividend, and it would have gone to P&L. Okay. So let us not bother about dividend for this year. Next year, we'll have to be concerned. I'll tell you about it. Good. Happy that you guys are following. So on 1/4/14, You have 7,500 shares. Value is 10,87,500. And on the same day, I purchased again 1414. I purchased 1,000 shares. And the purchase cost is, you should see it from, please see here. It has become 2,10,000 no. Yeah, please see, from 11,90,000, it has become 14 lakhs. How did it become 14 lakhs? That means he has invested 2,10,000 in it. Okay. So in the last tranche, he has actually invested 2,10,000. This is his investment which he has made. Now, on 30th September, I am supposed to see the dividend which I have received. Okay. On 30th September, I have received dividend. How much dividend I would have earned? I am supposed to remove only to the extent of this 1,000 shares, because other shares it is allowed to be there. Other shares it is allowed to be there. So 10 lakhs into 10%, because out of uh, my holding is only 1,000 shares. Okay, only for this 1,000 shares I need to be bothered about pre-acquisition dividend now. Into 10% into 15%. 15%. It gives me 15,000. It gives me 15,000. Okay. So let us draw. I'll explain once again. Let me first finish off. Okay. I'll explain. Don't worry. Please wait. Let me first close this off. Then I'll explain. Now, I have a closing balance of right now 8,500 shares. 8,500 shares. And the value comes to, oh, thank you, 12,97,500. I don't think so. 12,82,500. Okay. 12,82,500. Fine. 12,82,500 is the final number of shares and value. Now, let this be there. I will tell you why we have done this like this. Please see this spotlighter. I initially purchased 8,000 shares for 12,80,000. On 30th September, he says he has paid dividend on every 30th September. However, only in the first 30th September, I should be cautious, because the dividend is not my earned dividend. That is for last year dividend, which he is paying this year. Hence, I have deducted that from my investment value. That is first adjustment which you have done to your investment account. Same logic. Again, when I purchased on 1414 for these 1,000 shares, I will be receiving dividend. No. Did I actually earn that dividend? No. Somebody else is supposed to earn, but I got it. That means this 15,000 is also my pre-acquisition profit only. Hence, I have deducted here. Am I making sense? Is that clear for you all? Nandini. All right, done. So this is the table which we need for our next steps forward. So now what we will do is we will go ahead for consolidation under this for all these transactions. Now 3 bullet points are: date of consolidation, date of control, and shareholding pattern. I think shareholding pattern, it is date of consolidation is you are supposed to do it for independent years. Only then you will have a better clarity of this. 2013 dividend. 2013, you actually are eligible to earn the dividend. Hence, it would have gone to P&L. It will not come to investment account, no? Okay. So that's why we did not take any of the 2013 dividend to investment account. Now, date of consolidation is now this problem you are supposed to do on a trench by trench basis. That is, for each year, how will it impact? What if it is 31st March 2013 consolidation? How will it impact? 31st March 2014, how will it be? 31st March 2015, how will it be? Okay. So let us do it on trenches. So I'll first do it as on 31st March 2013. That means my date of control is 1st April 2012. Shareholding is 80/20. Now, step one, net worth analysis is supposed to be done. CR, share capital is already given 10 lakhs. P&L we are supposed to work out. Let us do that. Working note number 1. Please be cautious here. He has given you P&L balances on various dates. Okay, those are our basis to calculate now. So opening balance on 1/4/2012 is opening balance for me. It is given as 5 lakhs on that date. And then additions during the year less dividend for 11/12 is given there. 11/12 is given there. He has stated every year it is 1,50,000. No, so 1,50,000 can be taken directly. This is C. This is C, because generally last year dividend would be issued out of last year's profit only. Okay, and then current year earnings he did not tell you, and close it off. Closing balance on 31st March 2013 is given as 6,20,000. That means current year earnings would be the balancing figure here. The current year additions would be 5 lakhs minus 1,50,000. It is 3,50,000. Difference between 6,20,000 and 3,50,000 would be 2,70,000. Okay, so this is R. I hope you guys are able to follow. So C is going to be 3,50,000 and R is going to be 2,70,000. Okay, 3,50,000, R is 2,70,000. The total comes to 13,50,000 and 2,70,000. 13,50,000 will be split between holding and minority interest, same holding and minority interest in the ratio of 80/20. Amounts would be 10.8 lakh. Thank you. And 2.7 lakh. Same way, here it is 27 into 8. 27 into 2 is 54,000 first of all. So this is going to be 2,16,000. Thank you. Okay. So now only because I'm doing it on this whiteboard, I'm using multiple denominations, guys, lakhs, kilos, and thousands and numbers as I wish. But you guys don't do that. Examination, if the number is in thousands, you do it in thousands. If it is in lakhs, you do in lakhs. If it is full number, please mention full number. Okay, don't take that liberty like how I am doing in the class. So next, if we are done with this, let us go ahead to other parts. Now, in this step 2 would be minority interest. Minority interest, you have two categories. First one is capital profits, second is revenue profits. Capital profits are 2,70,000 and revenue profits are 54,000. So capital profits 2,70,000, revenue profits 54,000. Total is 3,24,000. Okay. Next, number 3. Cost of control. Cost of control. Investment in subsidiary is 11,60,000. How did I get this? From my working. Please see here. This is my basis. This is my basis. Okay. I have considered this 11,60,000 because there is dividend, pre-acquisition dividend received, which I am not considering in my cost of control at all. So considering that 11,60,000 in my investment in subsidiary, less share of holding company's share of capital profits. Capital profits share is 10,80,000. So goodwill is 80,000. Goodwill is 80,000. And then reserves for CBS. In fact, data is fully not available. Data is not fully available. H Limited's own reserves would be into, and then subsidiaries, share of subsidiary reserves would be from step 1, which is 2,16,000. So total would be X plus 2,16,000. Just for namesake, please hold. Okay. So balance sheet we cannot prepare. Hence, let us leave it. Okay. Now this is for 1 year. Okay. Now we will be doing the next step such that as if the consolidation is in the next year. We right now did consolidation as if it is being done on 31st March 2013. But now what we will do is second part of the question, we will do it for 31st March 2014. Okay. So that is number 1. So second is consolidation as on 31st March 2014. If that is my date of consolidation. So in this case, the 3 bullet points would be date of consolidation is 31st March 2014. Date of control happens to be 1st of April 2012 only. 1st of April 2012, because after that, though I sold 500 shares, I still have control. Okay. And shareholding pattern would be, here it is different. You cannot take 80/20 because as on that date, you sold 500 shares. Okay. Hence it is 75:25. This is what I meant net impact method. Okay, netting off method. Okay, so that means out of 80 I sold 500 shares, so I have 75 and the balance is 25, but date of control is same 1/4/2012. Old earliest date of control will be taken and recent shareholding pattern would be taken. This is what we do in if we have multiple stages of sale in between. Okay, so this is for now. Let us do step one here. Step one here, net worth analysis. Again, two parts. CR, share capital does not change, same 10 lakhs. P&L, again we will have to do a working note. Let us do working note 2, P&L analysis as on 31st March 14 we are doing. 31st March 14 we are doing. So let us do now. Now your date of control which you have taken is 1st April 2012 and the date of consolidation which you are doing is 31st March 2014. That means all the P&L transactions in between this period should be completely analyzed. Okay, so let us do that. Let us do that. So opening balance on 1/4/2012 is your starting point. 1/4/2012 opening balance happens to be 5 lakhs, which is C. And then out of this, you paid dividend for 11/12, which is 1,50,000. This is also C only. And then you paid dividend for 12/13, which is 1,50,000. This is R because it is dividend for 12/13. During that period, I hold shares. I hold shares. Hence, it is R only. And then I do not know current period earnings. For now, current period in the sense it is 12/13 and 13/14. Both together current period earnings. I do not know. And the closing balance which is given as on 31st March 2014 is 7 lakhs is given there. Okay, that means in the current period I earned a profit of 5 lakhs, right? This 5 lakhs is also R only because it is earned between these two dates of control and consolidation. Okay, hence it is 5 lakhs. Now if you see in your P&L account, in your net worth analysis, you are supposed to take 3,50,000 on C side and 3,50,000 on R side. The total comes to 13,50,000 and 3,50,000. Okay. Now this should be split between holding and minority in the ratio of 75-25. Holding, minority interest. Holding, minority interest. Values please. 75-25 is the ratio. Oh, thank you. 10,12,500 and 3,37,500. Here it is 87,500. Thank you. 2,62,500. Okay. So these are the values which we will take for net worth analysis. Okay. Any doubts still here? Any doubts you can raise? All right, let us go forward. Now, if this is done, we can go ahead with step 2. Step 2, minority interest calculation. Minority interest is very simple. Both those numbers should be taken. Capital profits and revenue profits should be taken. It is 3,37,500 and 87,500. Both together, it is 4,25,000. Yeah, thank you, Nandini. And then let's go ahead to cost of control. Cost of control. It is investment in, yes, you are supposed to take, please see carefully. Go back to your original thing, that is investment account which you prepared. Now, if you observe here, your investment value as on this date is 10,87,500 for that 7,500 shares. Okay, this is your actual investment value. Okay, so hence we will take only that. We will take only that. Investment in subsidiary, it is 10,87,500 less share of capital profits is 10,12,500. Thank you. 75,000 is cost of control, which is goodwill. Which is goodwill. Goodwill. Yeah. Next. Reserves for CBS, again same logic. Whatever is received from subsidiary, that we will show. I believe you know that, which is 2,62,500. That's all. Okay. So because holding company does not have anything, let me not do. Let's go to third year. Let's go to third year. That is in the year like as on 31st March 2015. As on 31st March 2015, how will this differ again? Okay, let us do here. Consolidation as on 31st March 2015. Okay, again 3 bullet points. Date of consolidation is 31st March 2015. Date of control is 1st April 2012 only. Okay, 1st April 2012. However, you have 2 dates here. First date is this, second date is 1/4/2014. Both dates are important for us because when we have subsequent purchases, you cannot go by net off method. You are supposed to go by incremental method. That's what I have told you in theory. Okay. Now we will see how it is done in practice. So 1/4/2012 is for first acquisition date. For second acquisition date, it is 1/4/2014. And shareholding pattern is it is initially you had 75/25. Then what happened is you purchased 10%, he sold 10%. Hence it is 85/15. So this is for first acquisition date and this is for second acquisition date. Okay. So you need to have this clarity, guys. Very important when we have subsequent purchases problems like this. So first acquisition date, you will take only the up to sales transactions. But if there is a purchase transaction, you are supposed to take the subsequent acquisition date. Okay. Now, this is how we will have to do net worth analysis now. Don't be in a hurry. I will do first, then I'll give you time to copy. Okay. So please see carefully. Whenever you have net worth analysis for multiple purchases, open two net worth analysis tables like this. Okay. C, R, C, R. Below first C, first date of acquisition, that is 1/4/2012, because that's your basis here. For below second C, take second date of acquisition 1/4/14. Okay. Now let us start. I will draw a jotted line here so that. So I will. This is very important so that you will not get confused. Now you have only two items: share capital, P&L. Only two items. Let us carefully do. Share capital as on 1/4/2012, it was the same 10 lakhs. Okay. Irrespective of the date, always it is 10 lakhs only. And share capital is always a capital item. Hence it is always on C side. Okay. Then P&L, let us start working. P&L, let us start working. Now your working dates would be 1st of April 2012 to 31st March 2015. Please see here, 1st of April 2012 to 31st March 2015 for first chart. For first chart, dates relevant are 1/4/2012 to 31st March 2015. But for second chart, what is relevant? 1/4/2014 to 31st March 2015 is for second chart. Okay. So right now we are working for first chart. Let me do it as a working note. Working note 3, P&L analysis as on 31st March 15 with respect to 1/4/2012. Very important. This clarity is very important. Now, opening balance you have on 1/4/2012 5 lakhs, which is C. On 30th of September, you paid dividend for 11/12, which is 1,50,000. That is also C only. Okay. Then dividend for 12/13 is paid. Dividend for 13/14 is also paid. However, these dividends are paid during the period. That too for after my date of control only. Hence, these dividends are revenue in nature. Okay. And I have earnings during this period. Earnings which I do not know. Let us find out. And he says closing balance of P&L on 31st March 15 is 8 lakhs. 8 lakhs. Okay. So my earnings here would be 7,50,000. Thank you. 7,50,000. This is R. I hope you guys are able to follow. Yeah, fine. 7,50,000. Okay. Now let us take each of these to first chart only. Only first chart. So what amounts will go to first chart? 3,50,000. Sorry, not negative. Okay. And 4,50,000. That's all. Next, you can total these and split it over holding and subsidiary. It is 13,50,000 and 4,50,000. So for 13 lakh 50,000, you already have breakup. It is 10 lakh 12,500 and 3 lakh 37,500. Please manage your space carefully. It is 10 lakh 12,500 and 3 lakh 37,500. For 4 lakh 50,000, it's going to be 3 lakh 37,500 and 1 lakh 12,500. Okay. So this goes to H, this goes to minority interest, this goes to H, this goes to minority interest. Okay. Now, please be cautious. Let's go to second P&L analysis. Working note 4. Working note 4. P&L analysis. What is shareholding pattern? See, it is 75-25, ma. For first chart, it is 75-25 only, no? That's what I told. You are supposed to take in the first case, after sale, whatever it is 75:25 and again 75:25. Please see the intro what I have given. 75-25 is for 1/4/2012 and 85-15 is relevant for 1/4/2014. Okay. Now don't be in a hurry to do for the second part. First I'll guide you through, then we will go ahead. Okay. P&L analysis as on 31st March 2015 with respect to 1/4/2000. What is the second investment date? 14, 1/4/14. Okay. Yeah, I'll tell you. Don't worry. Okay. Now you are analyzing the profit and loss account only from 1/4/2014 to 31st March 2015. That's all. Okay. Now please see opening balance of P&L on 1/4/14 should be your base. What is the profit on 1/4/14? It is 7 lakhs. This is C. Okay. And after this date, you would have paid dividend for 13-14 because every September you are paying. That is basically a pre-acquisition dividend, 1,50,000. That also goes to C. Then additions to be made during the year are there. I do not know what they are. That is profits earned during 1/4/14 to 31st March 15. 31st March 15. And closing balance given on 31st March 15 is 8 lakhs. That means profit earned during the year is 2,50,000. Okay. So this is R. This is R. Now this info has to be again taken to second part, that is incremental net worth analysis table. Now let us take on C side it is 7 lakhs minus 1,50,000, which is 5,50,000, and on R side it is 2,50,000. Okay. So this is your second part of net worth analysis table. Now don't be in a hurry. Your totals are 15,50,000, 2,50,000. Please recollect what I told you. In the incremental chart, you will be only having a split of incremental earnings. It will not be complete split of data into 85, 15 and all. Okay, that means holding and subsidiary will have a split. However, holding is getting 10% and minority interest is losing 10%. Same way from revenue profits also, holding is gaining 10%, minority interest is losing 10%. I hope you guys are able to follow this. On 1/4/14, I freshly acquired 10 more % shares. So what I should do is I should get that from the other party. That's all. Okay. Hence, I am taking that incremental earning out of him. Now, how much is 10% of 15,50,000? 1,55,000. And for minority interest, 1,55,000 will be lost. Same way, out of 2,50,000, I gain 25,000 and he loses 25,000. Did you guys understand? If you have any doubts, please let me know. I'll repeat once again. All right. So with this, let us go ahead to second part, which is your minority interest calculation. Step 2, minority interest calculation. Minority interest calculation would be, I'm taking blue color ink here. Add if it is positive, deduct if it is negative. Add if it is positive, deduct if it is negative. All these 4 plus plus minus minus, if you take, you get minority interest. So it is 2,45,000 it seems. Thank you. So minority interest is 2,45,000. 3,37,500 plus 1,12,000 minus 1,55,000 minus 25,000. I don't think it is 2,45,000. Yeah, 2,70,000. Yeah, correct. So minority interest is 2,70,000. Correct. Thank you. Next, third step, cost of control. Cost of control. Please be cautious. Please be cautious. Your go back to your investment account, which you initially prepared. Yeah, this is the investment account which you initially prepared. Now, I will take green. Yeah, please see. For your first tranche of investment, 10,87,500 was your investment, right? And then again you have invested 2,10,000, and then there is some income pre-acquisition profit of 15,000 which you have got. So you should take 10,87,500 plus 2,10,000 which you have invested minus pre-acquisition profit of 15,000. Okay, so that is your investment value. Okay. So cost of control in this case would be 10,87,500 plus 2,10,000 minus 15,000. I'm doing it really slow because you need to understand this concept. Okay. So total comes to 12,82,500. Yeah, thank you. From that, deduct your share of capital profits. Capital profits are to be deducted. Please see carefully. Don't be in a hurry. I am highlighting these in green. You are supposed to take this and also this. Both C side you are supposed to take. Both C side you are supposed to take. It's going to be 10,12,500 and 1,55,000. So both put together, it is come to 11,67,500. When you deduct, you get a goodwill of 1,15,000. 1,15,000 is goodwill. Okay. So this is it. Lastly, reserves for CBS. I'll tell you. Reserves for CBS, please see. Holding company, you don't know. And subsidiary, please see. Go back to your same net worth analysis table. You still have two numbers which are not rounded off. That is not considered till now. Those two are your reserves for CBS. So I'll round off them in yellow. So this and this together is your reserves for CBS. From subsidiary, it is 3,37,500 plus 25,000. Okay, so total comes to 3,65,000. 3,37,000 plus 25. How much is it? 3,62,500. Yeah. Thank you. Okay. So this is the problem, guys. Any doubts, please let me know. What is important for you here is how do we do this net worth analysis table? That's the only crux. Show working note 3 and 4. Okay. So this is 3. Please take. See, this problem, we made it this lengthy, but examination, he would give you one such transaction and ask you. There are instances in which they have asked. He might not add up multiple things like this, like one purchase, one sale and all, but either of these, he might ask you. So this is third working. I'm going to fourth working. Please see. All right. So let's go ahead to next question. Do you need break? We will continue till 8. Okay, fine. We'll take a 15-minute break and get back. Are you guys back? All right. So let's go to next concept in consolidation. Yeah. Now, I'll first explain how a chain holding accounting works. Then we can get into it. Now, chain holding is a situation where you have one parent or holding company and there are subsidiaries below subsidiaries. Okay. Whenever you have such subsidiary below subsidiaries, we are supposed to account for or analyze the net worth analysis of last company in the chain first. After that last company is done, those details are used for the previous company in the chain. That is the next company in the hierarchy. And once this company's net worth analysis is also done, finally we'll bring it up into main holding company. So this is broadly what we do under your chain holding. What I'll do is I'll quickly tell you the steps in consolidation in such problems so that it will be easy for you to adopt. Now, so first step would be net worth analysis of, say, ABC are the companies. Net worth analysis will be done for C, the last company in the chain. So as I always say, take C and R. You will have share capital, you will have reserves, you will have intercompany, URP, upstream, downstream, all those whatever you have, you please do. Once this is done, out of this you will have for B Limited there will be one share and minority interest other share. B Limited one share, minority interest other share. Okay. Now this first C part, B Limited share, will go to cost of control working. Minority interest will go to minority interest workings. B Limited's share of revenue profits will move from first table to second net worth table, second net worth analysis table of B Limited. Okay. This part let me explain later. For now, understand that this is a special category for you. This is a special category for you. Okay. So this is important. Whatever revenue profits of C Limited which belong to B Limited are there, they will move from first net worth table to second net worth table, because for B Limited also we'll have to do net worth analysis because that is also subsidiary company. Okay. Hence we will move this share of revenue profits of C Limited to B Limited's net worth analysis table. Now let us go to B Limited's net worth analysis table. B Limited's net worth analysis. This is second net worth analysis table. Okay, here you again have CR. First take whatever its own share, its own net worth analysis is there. Share capital of B will be completely C. General reserve of C, there could be C and R. P&L of C, P&L of B, there could be C and R. Like this, whatever results it has got, please take all those. At the end, share of revenue profits from C. Now, this amount could be coming on either sides. That could be coming on either sides. Okay, why either sides? Because B might have invested in C even prior to A's investment in B. Okay, or B might have invested in C after A's investment in B. If B has invested in C even prior to date of investment of A in B, in such case, whatever profits B is earning, there is possibility of capital profits also in it. Okay, hence you are supposed to split it between C and R depending on dates. Okay, so this is what happens for C and R. Now total all this. When you total all this, this will be split between A and minority interest. Again, A and minority interest in their ratio. Okay, after this, second step is minority interest calculation. Very simple. There are 4 points which you get in this, because you have two net worth analysis tables. So C's share of minority interest capital profits, C's share of minority interest revenue profits. Again, B company, from B company, minority interest 2 amounts. All 4 together will be considered as your minority interest. Okay. Next, number 3. Number 3, cost of control. What is cost of control here? You are supposed to take 2 companies' cost of controls. First one is investment of A in B. Second is investment of B in C. Okay. Then deduct less share of capital profits of A in B. Along with that, you are also supposed to deduct share of capital profits of B in C. On deducting these 2 pieces from your investments, what you get is either goodwill or capital reserve. Okay. Next, last step would be reserves for CBS. Be cautious. Particulars and number of amount columns based on types of whatever reserves you have. Say general reserve, P&L, capital reserve are there. Okay, so I'm taking all the 3 columns. Holding companies, that is A's own reserves, should be taken. Take as it is. If there are any adjustments for URP in A, you can do those there. Adjustments would be done. Then from B's share of revenue profits should be taken. Again, general reserve could be there, P&L could be there, capital reserve could be there. Please take all those. Next, from C's share of revenue profits will not come. Why? Because C's share of revenue profits, have already been transferred into B's share of profits. Yes or no? So that means the profits of B include C also. So again, I need not add them again. Okay. So hence C's share of revenue profits will not come again. After this, you can directly go ahead and close all the accounts and then prepare balance sheet. Okay. So this is how you do a chain holding problem. So let us do the question. Let us do the problem now. Please take out any doubts you can ask. All right. Let's read the question. Please see. From the following fifth question, from the following balance sheets of a group of companies and other information provided, draw up the consolidated balance sheet as on 31st March 2015. Equity shares of 100 each, general reserve, P&L, trade payables, bills payables, other current liabilities to Y and to Z. Then assets, fixed assets less depreciation, trade investments, investment in equity instruments in Y Limited at cost, investment in equity instruments in Z Limited at cost, investment in equity instruments in Z Limited at cost, and then you have current assets, inventories, trade receivables, bills receivables, cash and cash equivalents, other current assets, Z and X Limited total. X Limited holds 1,60,000 shares and 30,000 shares respectively in Y Limited and Z Limited. Y Limited holds 60,000 shares in Z Limited. These investments were made on 1/7/14, on which date the position were as follows. So reserves, P&L account, both the details are given. In December 2014, Y Limited invoiced goods to X Limited for 40 lakhs at cost plus 25%. The closing stock of X Limited includes such goods valued at 5 lakhs. Z Limited sold to Y Limited an equipment costing 24 lakhs at a profit of 25% on selling price on 1/1/2015. Depreciation at 10% per annum was provided by Y Limited on this equipment. Bills payable of Z Limited represent acceptances given to Y Limited, out of which Y Limited had discounted bills worth 3 lakhs. Debtors of X Limited include 5 lakhs being the amount due from Y Limited. X Limited proposed dividend at 10%. Prepare CBS of the group companies. Figures given in rupees lakhs, balance sheet as on 31st March 2015. First of all, by mistake, I have mentioned it as chain holding. It's actually triangle holding. Like this problem is triangle holding, but we will have also a chain in it. Okay. So I'll explain you what has to be done if it is a triangle holding. Whatever you have learned here will be appropriate for triangle holding also. I'll tell you how it differs. Now a triangle indicates A, B, C. A holds shares in B, B holds shares in C, and also A holds some share in C. Okay. Say A holds in B 90%, B holds in C say 60%, and A holds in C 10%. This becomes a triangle holding, and you are supposed to solve for this model. Now in chain holding, what we discussed is without this part alone. That's all. Okay. Okay. So if you if this part is included, it becomes triangle holding. Okay. So this part alone is what the entire difference is. So without this part, it is chain holding. With this 10%, it is triangular holding. Now considering this, if you have a if you have a triangle holding, it has got both features of chain holding and a normal subsidiary. That means from C, what happens is, while analyzing net worth of C, instead of splitting it into two parts, that is B and minority interest, you will now split A, B and minority interest. That is the only difference. But for that, there is no difference at all. So considering that, let us start this problem. Now, before we start, there are few important points which he has stated about all assets, liabilities. There are multiple adjustments which he has asked you. Do not think that so many adjustments will be asked for you in examination. Unless until it's a very simple consolidation problem, he won't ask you so many adjustments. Okay, that means there is only one step adjustment, one subsidiary adjustment. In such case, there is possibility for so many adjustments to be asked. Otherwise, he would not ask you with multiple question here in it. Okay, so let us observe each of these. First of all, we will have to understand what is the structure of this group. There are three companies, X, Y, and Z. Okay, there are three companies, X, Y, and Z. X holds in Y 80%. That is on 1714, and Y holds in Z 60%. That is again on same 1714, and X holds in Z 30%. That is luckily again on 1714. Okay. Now there could be problems where these dates could be different. That means Y in Z could be a date prior to X in Y, or Y in Z can be after X in Y, or X in Z could be prior to X in Y, or X in Z could be after X in Y. Like this, there are multiple possible scenarios. In this problem, it is simply given on the same dates. Now, if it becomes after, you are supposed to again analyze based on your share of revenue, profits, and all based on that date. If it is before, as on this date of control, you are supposed to test. Okay. So these are few important aspects which I am quickly telling you. Due to lack of time, we are not doing so many models, but this would be sufficient for you to understand how we will do. Okay. Had it been a regular class, we will do almost 50-60 problems on consolidation only, but now we are restricting it hardly to, I think it's 13 problems given for you. Okay. So now let's go ahead with the other parts. So first important thing is understanding the structure in which the consolidation is. Now that this is the structure identified, let us go ahead with consolidate. So as I earlier told you, we will first start with net worth analysis of last company in the chain. Step one, net worth analysis of Z. Net worth analysis of Z. You have two You have to split it into two parts, C and R. The date of control happens to be 1714. 1714 is your date of control. Now, for Z Limited, please see what all transactions he has got. He has got share capital. Share capital is 1 crore. Then there is general reserve. He directly gave you information in the bottom as a table. What is on the date of control and after earned is your balancing figure. So on the date of control, he has given it as 10 lakhs. Okay. And the balancing figure is from the question balance sheet. If you see 30 minus 10, it is 20 lakhs. Our side. And then P&L also, he has directly gave you information. It is 16 lakhs and 24 lakhs. I hope you guys are able to see it. And then you have upstream transaction here. Please see in the question. So Z Limited sold to Y an equipment costing 24 lakhs at a profit of 25% on selling price. Depreciation at 10% per annum was provided by Y Limited on this equipment. Let us go to Y Limited, then we will understand about the depreciation part. For now, understand that he sold an equipment. Understand that here he has sold an equipment, it's not inventory. Even then you are calculating URP. That is why what I told initially, URP generally it is inventory, but it can be for other assets also. So in this problem, it is for other asset. Okay. So it is 24 lakhs on which you are calculating 25%. So 25% is on selling price. That means on cost it is 1/3. If it is 1/4 on selling price, it is 1/3 on cost. So it's going to be 8 lakhs. Okay. So upstream transaction 24 lakhs into 1/3, it is 8 lakhs. So total you have 1 crore 26 lakhs and 36 lakhs. Now this 1 crore 26 lakhs should be split into 3 parts because there are 3 fellows above me. Who are they? X, Y, minority interest. Again, X, Y, minority interest. Okay. Now for X, it's going to be 30%. 30. Y, it's going to be 60%. Minority interest is 10%. Please tell me numbers, guys. 30, 60, and 10. $37,80,000 it should be for X. Okay, 37.8. Okay, 75.6 and it is 12.6. Fine. 12.6 and out of 36 lakhs, 3.6 lakh, 10.8 lakh and 21.6 lakh. Okay, thank you. Okay, now fairly speaking, with this it's not over. I'll tell you why. Now I'll do this part alone in a fresh page so that I'll be able to explain it better for you. You can continue in the same page. I'm doing it afresh because I don't have space on the board. Okay. So it is basically 20 lakh, 24 lakh, 8 lakh. So 8 lakh is negative here. Yeah, fine. 8 lakh is negative. Okay. So it is 20 lakh, 24 lakh, 8 lakh negative. So total comes to 36. This is split between three fellows. X, Y, minority interest. Minority interest is 3.6. Y is mentioned as 21.6. X is 10.8. Now, please recollect, I have mentioned that Y Limited's share of revenue profits will go to chart 2. If I have to take this 21.6 lakhs to chart 2, in which column should I take? Should I take it as part of general reserve or P&L? I don't have clarity. That's all right now. Hence, what we should do is this 21.6 lakhs should be further split into general reserve and P&L, so that when we go to second chart, in that respective place we will take. Okay. So wait now. Out of these three pieces of information given here, 20,000 is regarding general reserve. Yes or no? 20 lakhs is regarding general reserve. Out of 20 lakhs, 60% is 12 lakhs, right? 12 lakhs, please mention here. 20 lakhs into 60%. I am doing this only to ensure to place each of these number correctly at respective places in chart 2. Okay. And same way, while taking P&L, I will have to take both of these together. That is 24 plus minus 8, which is 16. Out of this 16, 60% goes and sits in second chart. Okay. So it's going to be 16 into 60%, which comes to 9.6 lakh. I am doing this split up because I need to take these values to respective places in chart 2 again. Second net worth analysis table of Y Limited. Hence I am doing this. Okay. Same way with respect to X, whatever is there, 10.8 lakhs. This directly goes to reserves for CBS, because this is the ultimate holding company. This is going to reserves for CBS. Now, in reserves for CBS, you are maintaining number of columns based on number of items. 10.8, if I directly tell, where would you take that? There is no possibility, yes or no. Hence, what we will do is this 10.8 also we will split into general reserve and P&L, so that in respective places we can take these numbers. Okay. Now, for general reserve, it's going to be 20 lakhs into 30%, which is 6 lakhs, and P&L it is again 16 lakhs into 30%, which comes to 4.8 lakh. Are you guys able to follow? Did you guys understand? I'll repeat once again, please see. Fairly speaking, your net worth analysis table for Z is over till here. But when we go to net worth analysis of B, that is Y in the middle company, Y Limited, I need breakup of this 21 lakhs, because in Y Limited also there is general reserve, in Y Limited also there is P&L. If I directly tell 21.6 lakhs, under what will I categorize it? It is difficult. Hence, what I am doing is I am splitting here itself each of those numbers, so that my job will be easy when I go to second net worth analysis table. Same way, this 10.8 lakhs should go and sit in reserves for CBS table. when this should go to reserves for CBS, in reserves for CBS, you have columns for each of the item, each of your reserve. So you need to give a split of how this, where this 10.8 should be. That is, towards general reserve, how much should go from Z Limited, towards P&L, how much should go from Z Limited. So to ensure that clarity, we are doing this working here itself. I hope this is clear. If you guys are done, we can go to next part. Okay. Now, if you guys are done with this, let us go to Y Limited's net worth analysis table. Y Limited's net worth analysis table, that is net worth analysis table of Y Limited. So this is your step 1B, that is step 1A, this is step 1B. Okay. So again, C and R. You have below C, the date important here is 1714 only again. You have share capital of 200. General reserve, what is given is general reserve. He says it is opening is 20 given there, and balance sheet it is 40. Hence it is going to be another 20 here. Okay. And general reserve from net worth analysis of Z, it is 12. Since both the dates are same, it is going to be on R side only. 12 comes to R side. Okay. Then P&L, it is 30 and 20, and P&L from net worth analysis of Z, it is 9.6. Okay, 9.6. Apart from this, now please read that he has given you details about the depreciation, blah 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 and all. Now depreciation at 10% per annum was provided by Y on this equipment. Now first of all, he sold an equipment for 24 lakhs, costing 24 lakhs. Okay, on 24 lakhs, what is the amount of profit he has made? 8 lakhs is the amount of profit, yes or no? So on 8 lakhs, please see what is the amount of depreciation for that number of for the amount of period. This is purchased on 1115. It is purchased on 1115, and you are right now on 31st March 2015. Okay, so we are consolidating as on 31st March 2015. That means you are supposed to calculate depreciation only for 3 months, right? So 3 months depreciation is the savings what I make due to this reversal. That means on one side I am reducing the profit, on the other side I am reducing the asset value in the balance sheet. So and finally what I am supposed to do is depreciation also I should remove from this particular Y Limited. Okay, so Y Limited, if I have to reduce depreciation savings will be 8 lakhs into 10% into 3 by 12. 8 lakhs into 10% into 3 by 12, 20,000. Okay, fine. Thank you. Okay, so depreciation savings 8 lakhs into 10% into 3 by 12. It is 0.2. This is savings, hence I am adding. Okay, so this is one part, and apart from that, there is one more adjustment with respect to sale of something by y to x. Please see the above paragraph. In December 2014, Y Limited invoiced goods to X Limited at for 40 lakhs at cost plus 25%. The closing stock of X Limited includes such goods valued at 5 lakhs. That means, though you have sold for 40 lakhs, that's not relevant. What is in the balance sheet, that is only relevant. So 5 lakhs is only in the balance sheet. For that alone, if I calculate upstream profit, upstream transaction, unrealized profit upstream, that's sufficient. So in this case, it is going to be URP upstream. URP upstream value is 5 lakhs into 1 by 5. It is 1 lakh. 1 lakh I am supposed to deduct because there is a profit already created. I am supposed to deduct. Okay. So at this juncture, I think these are the only transactions what we have under Y Limited. So sum up all this. You have got 250 here. Here it's going to be total of 20, 40, 50, 60, 60.8. 60.8 lakh. Okay. So 250 can be split into two parts, which is X and minority interest. 60.8 also you can split into X and minority interest. However, it should be further split because for my reserves for CVS I want. Okay. 62.8. This is 1 minus, sir. 20 plus 12 plus 20 plus 9.6 plus 0.2 minus 1. Depreciation savings, say explain once again, no problem. See, he says Z sold equipment for equipment costing 24 lakh at a profit of 25%. That means he would have sold for 32 lakhs. He would have sold for 32 lakhs. How did you get 32 lakhs? 24 lakhs plus 8 lakhs of profit. 8 lakhs we already calculated earlier. Okay. On 32 lakhs, what is the amount of depreciation you would have charged? 10%. Right? 10%. That too only for 3 by 12 months. So you would have got some number. Same way, you are actually supposed to charge only for 20 lakhs. 24 lakhs into 10% into 3 by 12. That you are supposed to charge only for 24 lakhs and charge it in your P&L, but you have charged for 32 lakhs. The difference between these two will be 20,000. Why? Because when you consolidate, you should give only for actual costs, but not on profited figures. Okay. So hence the difference is depreciation savings, which I have added back to my profit. Hope this explanation is okay. Yep. Thank you. So tell me the numbers here, please. So for 250, it is going to be 80-20. It is 250. For 60.8, we'll have to do. I'll wipe off this part and do for you. No, let that be there. I'll use colors here. So general reserve, these two figures together, you are supposed to calculate how much is 80%, and P&L, all these together, you are supposed to calculate 80%, so that I get proper figures. So from 60.8, it is X and minority interest. Minority interest would be 20% of 60 is 12.16. Thank you. And X is 48.64. This 48.64 breakup is what I want. It's going to be these two together into 80%. And again, all these four together, that is net off together, into 80%. Please tell me the values. (32 into 80% is okay 25.6, and this 80% is 23.04. Why do I need these breakups? Because I should take these values to my reserves for CBS. That's why. Okay. So with this, your net worth analysis of second company is also over. Let us go to minority interest. Minority interest from both the tables you are supposed to take. There will be four numbers which you get. The four numbers I'll highlight, please see. The four numbers I'll highlight, please see. So first number is this, second number is this, and then third number is this, and fourth number is this, 50. All put together, please tell me how much you got for minority interest. It's supposed to be 528. You won't get so much. 78.8 should be correct. So all these four together, it is 78.8, it seems. This is your minority interest. (12.16 plus 50), and then 12.6 plus 3.6. Okay, 78.36 it seems. Please be cautious with digits, guys. When numbers are especially like this, you tend to do mistakes. It is 78.36. So this is minority interest. Then cost of control, please do. Cost of control, you are supposed to take two investments, two share of capital profits. Okay, not two. Here it is three. Sorry, it's going to be three investments. Please see. Investment of X in Y, X in Z, Y in Z. There are three investments here. X investment in Y is 180 given, Z is 40 given, and Y in Z is 80 given. So total comes to 300. Yeah, and then share of capital profits. X in Z, Y in Z, and X in Y. These are the three numbers to be taken. I'll show you those. Okay, so it is first this, second is this. Okay, so X in Z, Y in Z is over, and then X in Y would be this. Okay, so it's going to be 200 plus 37.8 plus 75.6. Okay. So X in Z is 37. Oh, sorry. 37.8, 75.6, and 200. Total comes to 313.4 lakhs. So you have a capital reserve of 13.4 here. 13.4. I hope you guys are able to follow. Okay. Next. So if you're done with this, let us go ahead to reserves for CBS. Step 4. Reserves for CBS. Particulars. You have general reserve, you have P&L, and you have capital reserve. Be very cautious as you do. Be very cautious as you do. X Limited's own reserves are there in the question directly for you. It is 50 and 60. 50 and 60 plus excess share of Z. Excess share of Z would be, yeah, this would be excess share of Z. I'll highlight them for you. It is 6 lakhs and 4.8 lakh. 4.8 lakh. Okay. So 6 lakhs and 4.8 lakh are excess share of revenue profits from Z. 6 and 4.8 lakh. And same way, add Y's share of Z. Y's share of, excess share in Y. X share in Y, because Y's share in Z is already added into Y's net worth analysis table. Hence, you need not take Y again. Y's share in Z again. Okay. So X share in Y alone is to be taken. So that is going to be 25.6. So this part and 23.4, 23.04. Okay. So these two numbers will be for X in Y. For X in Y. Okay. So it is 25.6 and 23.04. Apart from that, you also have capital reserve which you have created in your cost of control, 13.4. 13.4 lakh. Okay. Now you can take totals 50, 75, 81.6, and then it is 87.84 and 13.4. Its total would be 182.82. Thank you. 84. Okay. 182.84 is your reserves for CBS, post which we can go ahead with consolidation balance sheet. balance sheet, let us do now. Equity share capital, no change, only holding company, 300. Reserves for CBS is 182.84. And then your minority interest. Minority interest is 78.36. Then trade payables are there. In this, he has stated that there is 5 lakhs of intercompany owings. So total is 50 minus 5, it is 45. Please read that if you want. Debtors of X Limited include 5 lakh being due from Y Limited. So that means I will have to deduct that part. I will have to deduct that part in both debtors and creditors. Hence, trade payables is reduced by 5 lakhs. Same way, it will be reduced for debtors also. Okay. Trade payables is 45, and then bills payables is bills payables also. He has mentioned you something there. Let us read that. Bills payable of Z Limited represent acceptances given by Y Limited, out of which Y Limited has discounted bills worth 3 lakhs. Now, first of all, bills payable of Z Limited, let us see what they are. See, bills payable of Z Limited are 5 lakhs. Out of 5 lakhs, 3 lakhs are discounted outside. That means I cannot cancel that. The balance 2 lakhs only can be cancelled. So it's going to be 10 plus 5 minus 2, 13. Okay. So it is going to be 13. And is there anything else I have? Other current liabilities, he has given there as 65. He has given there as 65. But if you observe, all these are intercompany owings only. 15 and 50 both are intercompany owings only. And at the same time, other current assets, if you observe, here it is also given, but it is only 40. That means there could be chances of reconciliation issues or something like that, or there could be chances of someone has paid but someone has not accounted for. So such chances could be there. What we will do is, on the asset side you have 40 total, you have 40, and on the liability side you have 65. Net of 40 in both the places and take balance 25. Okay. So other current liabilities is 25. Okay. So you can write this as pending reconciliation. Okay. Pending reconciliation. Now let us come to asset side. Fixed assets is very important. There are multiple items given to you in the balance sheet. There is 130 plus 150 plus 100. Then minus 8 plus 0 plus 0.2. What is minus 8? The profit made by Z. And what is plus 0.2? Depreciation saved. Okay. So it's going to be 130 plus 150 plus 100 minus 8 plus 0.2. All put together, you have got 372.2. Okay. Then you have inventories are there. Inventories 1 lakh got reduced. Yes or no? Y to Z, Y to X. There is 1 lakh which got reduced. So it's going to be net of 89 lakhs. 89 lakhs. Trade receivables, as I told you earlier, 5 we will reduce in both the places. 5 will reduce in both the places. So it's going to be 100 minus 5, 95. And then bills receivable, I already told you, it's going to be 2 deduction. So 30 minus 2, it is 28. 28. And cash and cash equivalents, total is 60. I believe with this, your balance sheet should get tallied. Please check once. It will get tallied. Tallied, huh? Okay, fine. 644.2 it seems. Okay, so this is it. So with this, let us stop here for the day. I'm sure you guys are tired. Let's finish off consolidation tomorrow at any chance. And then day after tomorrow, we'll start valuation. Finish that off in a couple of days. Then go to other standards, first generation standards for a day. And then I'll explain you with differences of IFRS and Ind AS. We'll close there. Okay. So tomorrow morning again, we'll catch up at 11 o'clock. Thank you guys. Good night.